regards to the use of maritime choke points like Hormuz and Bab el-Mandab as leverage. But we don't really see any discussions of a looming energy crisis in the mainstream media, not in the United States, not in Europe, or in really nobody's really talking about this. So despite the fact that U.S. oil inventories are at a 40-year low and are being depleted as we speak, the Trump administration appears to be on track to escalate the conflict. What is your interpretation of the most recent events in the Middle East from a geoeconomic perspective?
Well, the main thing is the announcement made from actually the president at Camp David yesterday. He had the whole cabinet up in Camp David, and it looks like they have targeted some oil facilities and energy, stations, and they will attack.
It just takes too long. It just takes too long. The general point with that is get ready for an oil shock, everybody. Get ready for hunger. Get ready for a change in circumstance. We're so used to things working out that we're ignoring the risk. All right. There's only 5 of you here. I get it. It's Sunday. There's more important things to do, which I hope involves family and God and taking a break. But yesterday I didn't come on. I paid attention to those 3 things yesterday. And I also spoke with a handful of you guys and girls. And I think it's going to be important to work hard, for me to work hard during August. I can't afford to take a break. But historically in my life, I never did. I always just worked through. Everybody else went on their breaks and their travels, and I sat and worked. I'm not sure, the way I present that might come across that is somehow better. I'm not sure it is, because I think the body and one's ability to work, as Professor Sanderson's, the single most popular professor on our campus, who became my advisor, would tell us. He'd say, gee. And he would just point out that if you studied for an exam 8 hours, and then you decided to study all night, and you went into 12 hours, 16 hours, that your marginal rate of productivity fell sharply. And sure enough, I think that's probably true. Just working, saying you're working, doesn't mean you're getting anything done or that you're effective at it. But having said that, for me, I think I have to work during August. And for those of you who have time to listen, that's awesome. But we have to distract ourselves with Railtown. It's not a huge increase, but you are now at 23,724,613 shares. You are 23,700,000 and essentially 25,000 shares. It's incredible. You're almost 24 million shares. That is the single largest position I know of in Railtown, with the possible exception of Marwan Haddad. I'm not clear on what his exact position is. It's something like that. But you're bigger than any institution. You're bigger than any wealthy investor. And you've done, other than people that are close to the company, you've done more due diligence to date than any publicly disclosed institution anyway. There may be some 1 or 2 or 5 or 10 that have looked into it deeply, and they just aren't in a position to be able to buy yet. But that'll change. So you're basically 23,725,000 shares. It's incredible. But we have to distract ourselves from the day-to-day pricing in Railtown over August. Why? Because I think there will be vacations. I think it's clear to me younger generations of attorneys, regulators, and bureaucrats at larger companies, particularly in Canada, are driven by other motives. Well, other priorities. Their motives are probably the same, but the priorities are a little reorganized from how I remember it in my segment of our generation. But it's my perspective, so maybe other people perceived it differently. Whatever it is, I just want to point out it's highly unlikely there's going to be meaningful information on Railtown or anything associated with Railtown during August. And we just have to accept that fact. Now, it doesn't mean anything's going wrong at the company. Doesn't mean that things aren't going to be extremely exciting in September, October, November, even maybe December for a change. Doesn't mean that. It just simply means vacation. That's all it means. And during vacation, my opinion is these combines that reap are going to continue to run. Okay, so I'm going to take it upon myself to, instead of slacking off in August, is to do more if I can, as long as my energy doesn't run out. And part of it is to educate, give you my points of view, and get ready for what I think is going to be an exciting September, October, November timeframe. I received my shares of NextBridge. It's only, I don't know what happened. It's only part of my position. I think maybe there were 2 certificates, but also this one, they misspelled my name. So maybe there's another one pending. I'm going to have to call in. But I did receive at Equinity Trust Co. my 100.166 shares. That was one part of my position, roughly. I don't remember, 3,005 shares or 3,004 shares, something like that, 6. That was one position. So I'll call on Monday and find out what else happened. But on MMTLP/NextBridge, I did receive my dividend shares at Equinity. So I would assume everybody else did too. And I think it's a really keen reason to transfer your shares. The numbers I remember roughly 60 million shares, maybe 70 million shares, are still available to request and get transferred. If your brokerage firm isn't cooperating, pull out that PR and say, hey, it says right here, you have shares as of this date. I demand them. Put it in writing. So at least if they don't do it, and this all goes to some sort of knockdown, which it already has been, legal fight, you'll have a record that you asked. I think the single biggest argument that the other side is going to make is you abandoned your property by listening to people like Double D and not doing anything. You proactively have to ask for your shares. Do it. Do it in writing. All right. Today, what I'm going to go over with you is, and I hope there's a lot of questions because I want to interrupt it with questions. There's really nothing new to tell you about Railtown. I can keep searching, but I've covered every angle I can think of. I believe the price of Railtown is grossly understated. On the other hand, if you're someone new to the market or you're an outside observer, a company trading at $50 million with essentially zero revenue and a description of being a software as a solution company that helps developers help other developers and everyone gets to get along, it's not going to cut it. It's not going to cut it. Do you mind if I say something, Captain? Yeah, Callahan. Your mouthwash ain't cutting it. It doesn't cut it. So, but that'll change. That'll change. And unfortunately, Canada is uniquely slow in all aspects of life. So I think those descriptions will change. I think news will come out. If I had to guess, you're going to see, news, any one piece of news is not going to change it. What's going to change it is the perception that they're executing on their plan. They're doing what they said they're going to do. And then in the background, analysts start plugging in their models. And those models lead to buying. And the buying leads to institutional buying. And that's all you need, whether we know what it means or not. That's what we need. And I think it'll come September, October, November. It's been a long wait. I feel totally drained and pulled down by it myself. So I can only imagine how you feel. But I do not think the thesis for Railtown has been destroyed. In fact, I think the thesis for Railtown has only gotten better. But time wounds all heals, as my grandmother told me. But in this business, time helps the heals. It helps the churners. So let's move on from the intro. I did tell, for those joining late, I told everybody we're at 23,724,613 shares of Railtown. That is our commitment. That is our focus. But when this goes to $1, $2, $3. My focus is going to be keeping you in it. And then when it goes to 5, 10, 15, it starts making sense to study the facts as they are at that point and revisit. I'm just to reemphasize, I'm not about diamond hands. I'm about you making money. And money is very difficult to make in these markets. You got to set up your probability. And sometimes you got to focus on one. Sometimes you trade something on the margin. And other times you got to ride what you have. And it's an art, not a science. But I'll tell you simple bumper sticker rules and little, ad hominem, sounds good type advice. Mantras are not going to do it. Each of us probably most of us are here because we got spoiled on our first 1 or 2 trades in this space over the last 5 years or so. And the problem is that was luck. We didn't realize it, but that was luck. Having said that, I think particularly in the case of Railtown, and I think there's other investments too. We've done the due diligence. We've done our arbitrage, which is time. And I think we're about to get rewarded. So we do not want to be shaken out. Donna, if she comes here, I don't know. She was very kind to send me something that was posted about me. I don't know if it was something to listen to or read. I didn't look at it, Donna, because I don't want to get upset. But remember, it's my contention that others out there are trying to befriend you, trying to ridicule me, trying to make it personal, trying to engage in emotionalism as opposed to critical thinking and as cold analysis as one can make. Now, in every investment, there's going to be some things you bank on, you study, and you have confidence in, but you don't know for sure. If everyone knew, in my opinion, Railtown would already be a $55 stock or $25 stock. But you don't know for sure. And that's where they play you. So Railtown is not about me. The company doesn't particularly even talk to me. I mean, I've been invited, I think, over the last 6 months or so. Well, no, it's already August, so it's over the last 8 months. I think I've had the pleasure and the privilege of speaking with Corey 3 times. It might be 4 times, but I think it's 3 times. So it's something, but it's not like I'm here. I haven't been hired to promote it or anything. And, we've done our best. All right. So there looks like there's some hope in the Middle East. But, it's the middle of the summer with a guy, with a liar like Netanyahu. That's my judgment. And someone who is devoted to Netanyahu like Trump. That, again, my judgment. I think they may just be trying to buy time for a September, October invasion. I hope not. I hope this one sticks. I hope there's a solution here. I think Trump is good at making a deal and accepting new facts. If that happens, we may escape the worst of it. But the reality is the world, one, is missing a lot of oil and natural gas and the products that come off of it. We are already. And it's too late for the people who are going to starve and for food prices. It's too late for gasoline prices. Secondly, Wall Street, which, you know, if you recall, one of the reasons I focused on Railtown last June, I told you that Wall Street was going to be educating their troops, so to speak, about AI, because I saw it from my old office. A friend of mine sent me the Morgan Stanley research and James Altucher, the concepts, and I predicted that correctly. They're truly began a wave of capital going into what the broad description is AI, and it hasn't stopped. It's only accelerated. They've moved, Wall Street has trained its teams so much that they've moved people into recommending to their retirees and wealthy investors that they put money in these insurance wrappers where they get a 25% bump up in value, because underlying it are your Apollos and your BlackRocks using other people's money but earning the fees to take the risk to invest in the data centers. And then how'd they do it? They got around the rules a little bit by buying insurance companies. And then they offload the risk to something offshore to elide or evade rules. And so there's a concentration of risk, and people think, wow, we're safe. We're in an insurance deal, and I've got this income guaranteed. I've got this principal guaranteed, and they're all calm with it. But what they don't realize is those data center deals are going to get renegotiated, and those long-term insurance contracts they signed into might give them 3 or 4% per year over the long run. Might. It's more likely going to be zero. It's more likely going to be lawsuits. There's going to be panic. It's going to be a nightmare. My prediction of what's going to pop the bubble of this 44-year-old bull market is private credit, the over leverage, and particularly in these insurance products. But regardless, that's the educational system of Wall Street telling their troops and wealth advisors. Wealth advisors are only slightly better positioned than a rookie. They are still on the ass end of information. They still represent retail clients, and the information they get is after BlackRock, Fink, and Blankenfeld, and Blichtenstein, and Schwartz. It's after all that. So it's still, they're slightly above the ass end of the investment world. They're right above retail, but they're the patsies. They're the ones that are told that you know everything. They've got research backing it up, research pieces, and then you've got the glossy presentation, and it's insured. They're just functional patsies. You who are buying it are the patsy. That's where I think the blow-up's going to come. But they'll kick that down the road. Well, what's going to happen now? Because of what's happening on behalf of Benjamin Netanyahu, who I think from the age of 24, my opinion, I watched him in what they call moot court. I think he's always been a bully and always been a liar, my opinion, always. And I think he's an idiot. He's sly. He's sly. he uses tools most people wouldn't use, but I don't think he's a particularly bright man. But he's been trained how to argue, how to win, how to never quit, how to have no feelings. I don't know where that man has feelings, maybe towards his wife. I don't know. That's for someone else to judge. But because of the massive blunder that Donald Trump made, Donald Trump destroyed his legacy by doing this. It's over. He could have seized the opportunity to make it a more than détente, more than a rapprochement, an actual engagement with Russia, and Donald Trump would go down in history as a great president. He could have made deals with Iran, same thing, China. Instead, he's put us on the brink of war over the Straits of Taiwan, over the Strait of I forget the name of those straits over there. It's not Malacca. It's anyway. But the number one thing Trump did is he ripped off the shade, the blur, the rose-colored glasses, and he pointed out that the emperor really is wearing no clothes. And so it's a before and after event. You're going to start seeing the after effects. But one of the things that's going to come, and it's going to come as soon as September, Wall Street will start teaching its people about oil and gas. And there will be oil and gas partnerships. Private equity is going to go out and seize, in their wisdom, they're all 32 years old, locking up projects, and then they're going to stuff oil and gas deals in your investments. And as oil goes to 100, 150, 200, 250, and it may not stop there for the rest of your lives, there will be volatility. There will be volatility. If there's a crash, everything will go down during the crash. But there's not enough oil to fight a war and reshore and bring the just-in-time worldwide delivery systems, supply systems, to bring them back to the United States and North. There's not enough oil. And we do not, contrary to Donald Trump's, I think, belief that the United States is independent in energy, we are not. We are not. Now, if we can claim Canada, Venezuela, maybe Cuba, maybe we'll get there. Maybe Greenland, so we can get more into the Arctic, maybe. But why is the Arctic going to work? Because the ice is melting. Think about the ice melting. Particularly you guys who hate Trump and you're gleeful about climate change. Well, don't be so excited. I'm seeing signs of what I was a lonely oddball 25 years ago talking about climate change. Scared the heck out of me. The only reason I don't talk about it anymore, I have to deal with my own survival now. But I had a house where I had to be. I had room in it for people to live if it just came down to that. I knew my neighborhood. I was friends with everyone. And I had space where I could grow food. I had a way where I could install solar panels if that came down to it. It was an old house, so it was able, in most of the times of the year, to flow air through it. So I was not dependent on electricity. I had 3 working fireplaces. So even in the dire time, you just sit around the fireplace I had room to store. I had all of that. It's all gone. It's all gone. And so now I just focus on helping you and my own recovery. So I don't have time to think about climate change. But melting glaciers in Greenland or in Alaska is one thing. That's like ice cubes melting in your gin and tonic if you haven't touched it. It comes up to the rim, it gets a little bit of a top over it, and when you pick it up, it spills a little bit. But after you've had some of your gin and tonic, and the waiter comes around and says, maybe it's in a premixed jug or decanter, and the waitron comes by and says, "Would you like some more, sir?" "Sure, sure." And she pours it, and she's doing her best, but ice comes out of the container onto your glass. Well, it's not melted, but it's suddenly in your glass. It overflows, and you step back. She says, "Oh, I'm sorry, sir." No problem, no problem. And you go about your life. It's just a gin and tonic. But if the Doomsburg, I think they call it, the glacier. There's a glacier down in South America it's on land, it's on rock, it's on land. But if the glacier in front of it melts and that slides in to the ocean, it's the size of Florida or New Jersey or the UK. I can't remember which. But it could rise the sea levels, I suppose, with a series of waves and reverberations. But if I remember correctly, it can cause sea levels to rise something like 8 inches or a foot or 2 feet. I can't remember. But imagine if you're in New York or Miami or along the beaches. Imagine further. Why don't banks tell you about this? Most of the world's wealth is leveraged, and it's near the sea. Imagine what it does to the financial system. Tornadoes are moving because of climate change. What does that do to the financial system? No one talks about Fukushima Daiichi and the fact that there's been 3 or 4 bigger earthquakes in Japan. They use a different reporting system so they don't sound so bad, but they're actually bigger than anything we've ever seen. And there's nuclear plants all over Japan. How many Fukushima Daiichi disasters are there? All it takes, particularly women, because people listen to women. They don't listen to white-haired men. But if women in California, and an actress, for example, a Kim Kardashian, decided to study and it crossed her lightly challenged brain that why are all these whales starving? Why are these cases of cancer coming up? Those would be 2 issues she might study. She might study, if she's really hardworking, she might study why insects and crabs and other animals, plants are gone from northwest Canada. I doubt she'd look that far. No one's looking. She might wonder why the storms in the Pacific are so strong. There's one, I guess, about to hit or did hit Hawaii. Why are they so strong? Could it be all the radiation in the water? I don't know. But all you need is someone like Kim Kardashian to suddenly sell her real estate in California and state why. I want to get away from the radiation. I mean, that I don't think that's happening anytime soon. But if it were to happen, imagine the panic to real estate prices and again, the threat to the financial system. Imagine the threat to the financial system as people realize that our so-called energy independence relies on a lot of unconventional oil, which apparently cannot be split out into diesel. So what if diesel goes to $10, $15 a gallon? What does it do to our suburbs? What does it do to real estate values in suburbs? I can go through a whole list of these, but I'm telling you, there's some real challenges to the financial system and to your life in the future. It may not start right away, but it's coming. And so we've got to be ready for that. We've got to make decisions that make our accounts valuable. Ironically, I think AI is a huge part of the future because of how it can allocate resources and how people can work from home or work maybe in closer walking distance from work and rather than driving. Gasoline right now is roughly $4 here. I live in a city. It's probably in Virginia. I bet it's $3.25 or something, but $4. Oil right now is 100. I mean, just do a thought experiment. If there's a panic in oil, if the world breaks down into competing zones, Russia, which, you know, Russia's hasn't always been an ally of China, but idiots like Victoria Nuland, who's never been punched in her face in her life, likes to, with a lot of bravado, start wars. I'm sure the same could be said about Dick Cheney and Rumsfeld. Doubt any of them been served in war. But as the world breaks up into sections and gets the inefficiencies associated with that, and I'm not saying straight up, but you can imagine a world where oil is $250 a barrel, not $100. Well, that's 2.5 times where it is today. So if you're paying $4 at the pump for gasoline, just do it as an experiment. What would you do if gasoline were $10 a gallon as you drove around? Just look. How many people are living on edge? What happens if diesel's 15? Are the stores going to be just-in-time delivery? How's your life going to be affected? Can you drive to work an hour and a half each way? Can you have kids across town at school and sports events on the other side of town? What's going to happen to travel? And then start thinking about the values of the exurbs, much less the suburbs, and start thinking about how does it reorient life? And what's the value of all those properties as they're recorded on banks' balance sheets? That's at $2.50 a barrel oil. What if it goes to $500? $20 gasoline? Look, I believe all these things are in your future. And I think Trump, as the gigantic catalyst that he is, has just sped everything up. And it'll be squarely blamed on him because we have no friends anymore. There's not a single country that's our friend anymore. And I'm not saying that you should have friends as a country, but no one trusts us. We've taken the side of the modern day Nazi, who in my opinion, is Benjamin Netanyahu. And we're going to go down on the wrong side of history now. And I guess that's just how God plays dice with us. So we realize we can't get bigger than our boots or our pants. All right, I'm going to move on from that. Just get ready. There's going to be major dislocations in your life. So let's intelligently approach what we're trying to do here. And there are ways of winning. I did a study on Lynn Partners deals, by the way. I'm not going to talk about that today. And I don't think it's complete because it's hard to find everything. But even in their nightmare pursuit of greed, and in my opinion, usurious, not sure I'm pronouncing that correctly. If any of you have worked in real estate, they're the hard money, but they're also a marriage of hard money with sort of the, gamblers borrowing money from a mafiosa type, in my judgment. But even in their case, what I could find, 3 companies out of 19 were able to escape and thrive. So there's a way. There is no financing for these companies. And that's the great tragedy. If Donald Trump, instead of focusing on the spoiled, lying brat Netanyahu, if Donald Trump focused on making American markets vibrant again, he'd go down in history. But instead, he's hitched his wagon to a loser, a complete loser. That's what happens when you get a lot of choices and you make the wrong choice. You take your chances and you pay the prices. All right, so let's, did I tell you that you guys now have 23,724,613 shares? 23,725,000 shares of Railtown? Did I tell you how great you are? How great thou art. How great thou art. All right, let's see what some of you have to say. And then and the problem is, once I answer all these, then nobody ever puts anything else up. I'm going to move to talking about things, and I could be here 2 hours. So I'd love some feedback just so I can break my brain up. Chestnut, good morning, William. Good morning. What a great dog. That dog, once he loves you, you can hug him. But until then, you can't hug him. Ricky Brogan. Hey, William and RT. Hi, Ricky. Fast Eddie. How do? Fast Eddie. Chestnut. And good morning to the RT crew. Jem, this is a nice comment. Jem says, finger your butthole. I don't know. Are you an owner of Finger? Are you just giving me advice? Do I have constipation or something? Did you hear the one about the mathematician who had constipation? He had to work it out with a pencil? I don't know your point, Jim. I'd try to answer that, but that doesn't give me much to work on. If you're saying that I got you in trouble with Finger, that stock was never my idea. If you're saying that 4 or 5 years ago, I don't remember the exact time, I believe Finger could squeeze, and that, you know, not that you would know, but I told a lot of my friends about it. And when it went up, I didn't get out because I thought it was squeezing. So, but I got that whole narrative from him. I'm not blaming him, but I got it all from him. I gave him a lot of time here to talk about it. Maybe that's what you're upset with. But you know, in my own defense, for about, I'd say 2 years, I've been very clear. When Finger's up, sell it. It's a trade. It's going to be very difficult. And more recently, 2 Decembers ago, I supported Martin Shen's taking of what was a financing which I think helped the toad. In December, I forget how much he took. I think he took about 5 million face. He didn't get that much back because that December, I just didn't think he had any option. They were going into Chinese New Year. I didn't know about it beforehand, but I at least understood it. But then that first quarter, he did another financing with insiders at about, look, the stock was 550, but it might have been lower by the time they went in. But they did it under the market, and they raised about 300,000, something like that. You can go look it up if you take time to do it. But he. I remember talking about it. I said right now he should be going to Roth Capital and borrowing a big amount of money, even if it's this nightmare deal. Why? Because of the C2 contract that was supposedly exclusive with the government. It covered all of China, and the numbers were huge. I felt like, well, you've got 5 million working, whatever's left over from it already. Get another 5 or 10 million working, and then have every quarter these kick butt revenue numbers and keep reinvesting. But he didn't do it. And so I talked about it then. It either was that the C2 contract wasn't such a big deal, or Martin's role is more as a functionary, more as an accountant, almost a nice one, but not as a seer and a leader. Well, anyway, after that, I think it was January, February, March, maybe it was May, might have been April. Once it became clear when they put out their earnings report that nothing doing on the C2 contract, they made 50 grand or something. And that he let his stock go from 550 all the way back down when I was saying sell it, by the way, and everybody's buying calls, I'm saying sell them. But all the way back down, he didn't do any financing. And that's when I just really thought that there's not leadership, that the C2 contract is not meaningful, and that this is not heading anywhere good. And I talked about it constantly, but I did it quietly because I think people are reluctant to give up their beliefs on a stock. And I'm not trying to cause a fight with anybody. Most recently, Jem, I took my finger out of my butthole, and I uh, did some work and research on the most recent financing from a company named Weidel, who financed Finger. And somebody here asked me, and to me anyway, she's a friend of my community. She said, is Finger Motion going to $5 like Ham says? And I said, I looked quickly at the financing, and my quick answer was no, it's not. And then I promised her that I would do some work, and I did over the weekend, over the next 3 days. I almost published what I came up with, but Ham let me know I was an idiot with another descriptor in there. And I started thinking, Ham's a good guy. I don't need to provoke him and step on his toes. So instead, I continued to tell people to get out of Finger and buy Railtown. That's been my mantra since one investor a year and a month ago, because we just started August. So a year and a month ago, I told one investor, I remember it vividly. She had 1,000 shares of Finger. If she was on here, I couldn't give her personal advice. I could just tell her what I would do. I said, sell it and buy Railtown. At that time, she could have purchased 12,000 shares. She might have had to add a tiny bit of money. For 1,000 shares of Finger, she could have purchased 12,000 shares of Railtown. Now, I don't know if she did it or didn't. And there's no question Railtown's down since that time, probably down at least 20%, maybe a little bit more. But you know what? She still has 12,000 shares of Railtown at, I can't do the arithmetic anymore in my head, at 23 cents or 20, let's call it 23 cents. So she still has 2,700, 2,800 worth of Railtown, which I think in very short time frame could be 28,000. And I even think by the end of the year, believe it or not, I think by the end of the year, first quarter, that could be worth 280,000 to her. But if instead she held on to her Finger Motion and didn't make the swap, she's got $250 worth of stock. So it's been pretty good advice. I think if Finger Motion had strategically taken advantage of the difficult financing that's available, but had used it to create massive sources of ongoing revenue in that C2 contract, you'd be talking about a completely different company. Instead, they've gone the route of hiring people, talking about how there's going to be a squeeze. I don't think there's going to be a squeeze in Finger Motion. I've been very clear about that I think for almost 3 years. But if you have the time, my videos are all out there. I haven't erased any of them, so you can go watch them. But so I appreciate your recommendation, Jem, and I'm glad you're here. T. Alex, happy Sunday to everyone. Hi, T. Alex. T. Alex, used to be Family Day, I know, but not everyone has a family. And I think it's pretty clear. My brother used to point this out to me. Now I'm seeing it. I didn't see it for 20 years, but I think there's been a move to break down the American family. And I think it's been largely successful. I wonder if families grow to love each other because they spend time together, or just because they are family, they love each other. I don't know. I think it's probably you need to spend time with each other. Ward Richardson, good afternoon, William and RT crew. I see Dr. Tom Core announced the 200th partnership with AIP. Cinchi, another disruptive software company joining RT. I didn't see that before I got started this morning. But yeah, that's pretty important. 200 companies. And imagine if one of the reasons Railtown has had to keep their mouth shut, so to speak, is because there's government funding pending. I mean, it's a logical thing. Dr. Tom Core spent his career organizing funding at the highest levels in Canada for technology companies. He's now the director of business development at Railtown. And Carney's AI for All, there was some committee meeting last November. That's Canada. You got to have a lot of committees. But that might have started all manner of things that we consider delays, but in the long run are beneficial to us. And then Atufat Shamsi joined. That's TELUS. Joined the advisory board, but he works at TELUS building the stacks. And, all the other gentlemen who joined the advisory board. And then Dr. Tom Core's been talking about BuzzHive Digital / BCE, not talking about it, just reposting. And it makes you wonder, was that June 1 cutoff for funding in Canada for applying for it, was that a period of time where the company had to be quiet? And does that quiet extend to as the government and the provinces sort through all these deals? Is it until something's announced under penalty of losing funding, you don't talk? Could be. And then if you recall, the acquisition of AIP Partners was sort of they all at the same time they got a contract or a joint agreement with Digital. And Digital is an organization probably very close to Dr. Tom Core, which can go in and apply for that funding. And maybe they were playing 5D chess while we're, wondering what happened to one of our checker pieces. Who knows? But I think it's great announcement. I'll try to find it. I don't know that I can here, but it's good as ever to have all you guys supporting this. And Ward has done great due diligence on behalf of all of you. And he didn't just start it. He found this company before he ever found this channel, and he's been working on his due diligence for a long time. Jack Hamilton, good Sunday afternoon to you, Mr. William and RT fan club members. All right, let me see what I have. What happens lots of times is I do this research, and then if I don't get to it right away, I forget what I did. But I might have some Dr. Tom Core stuff here, but I'm not sure it's. let's just see what I have from the other day. And if it's meaningless, I'll stop and we'll move on. Okay, so I asked what's the new NASDAQ rule? What's the new NASDAQ rule? The main new NASDAQ rule relevant is one approved by the SEC on July 22nd, 26. And it's the continued listing requirement for a minimum market value of listed securities at $5 million. It applies to companies on the NASDAQ Global Select, Global, and Capital Markets. MVLS is calculated as the consolidated closing bid price times total shares of the listed class outstanding, including restricted and affiliate shares in the calculation. If MVLS, that contradicts what we found out the other day, but okay. If MVLS stays below 5 million for 30 consecutive business days, NASDAQ issues a staff delisting determination. Trading is subject to immediate suspension and delisting proceedings. There is no standard cure and no compliance period, unlike the familiar $1 bid price rule, which used to or typically does give 6 months, 180 days. Appeals generally do not stay the suspension. To regain compliance, companies often need to meet initial listing standards rather than just the continued listing standards. This is part of a broader NASDAQ push, along with higher public float IPO proceeds thresholds being a requirement, faster delisting paths for thinly traded names, and discretionary power to block manipulation-prone listings. So this is a part of a broader NASDAQ push aimed at microcaps that are more vulnerable to volatility, thin liquidity, and potential pump and dump activity. I think the dumping often occurs before the pumping, but all right. Roughly 180 NASDAQ listed companies were already below 180 of them were already below the $5 million threshold at the time of approval, right around July 22nd. So 180 companies. Why stocks like CYCU run up, do financings, and then sell off? Companies, as an example, Cycurion, could you get a worse name? Is a classic microcap example that has recently dealt with NASDAQ compliance issues, bid price, equity, market value tests, reverse splits, equity lines, pipes, warrant inducements, and sharp volatility. Recent activity has included large volume spikes, contract announcements that sparked big percentage runs, and dilutive financings, for example, equity purchase agreements, warrant inducements priced at market. So the pattern you describe is a common response to the new and, to be fair, prior listing pressure rules among low market cap names. One, you get a run up in price. Two, 1A, 1B is you get temporary price support. Temporary price support. the stock gets promoted, news, whatever, contracts, partnerships, news hits, or short covering liquidity events occur. Higher price helps push the MVLS, which is essentially the market cap with that formula. It helps push the MVLS above the $5 million floor, price times shares, or keeps the 30-day clock from starting or running. Thin floats make percentage moves easy. Number two, financing share issuance. Management raises capital via registered directs, pipes, which are private investment public entity, equity lines, warrant exercises, inducements, or convertibles. This does two things that help compliance. It adds cash, useful for operations, and it helps show viability, and it increases the share count, which directly boosts the MVLS calculation if even later the price softens. These deals are often done at a discount or with warrants, and they are frequently structured to try to stay within NASDAQ's at the market or shareholder approval rules where possible. And then the third part of the pattern, you see a sell-off or dilution pressure. Once the shares or the underlying expansion of shares from warrants and convertibles hit the market, existing holders and the new investors frequently sell into the liquidity. The increased float plus any overhang creates downward pressure. Speculative momentum buyers who chase the run-up also exit. The net result is the familiar, quote, pump leads to dilute, leads to dump, unquote, cycle in the price chart, even if the company temporarily improves its MVLS path, its price time shares being over 5 million path. In short, the new $5 million MVLS rule, with its no cure, fast suspension design, intensifies the incentive for microcaps hovering near or below the threshold to engineer temporary market value boosts via price action plus share issuance. The subsequent selling is the market digesting the dilution and the fading of short-term catalysts. This is not unique to one ticker. Similar dynamics appear across other low market cap NASDAQ names facing this same compliance clock. And then it says check the filings for the details, which I always do, or do my best at it. They're very lengthy. Does a run-up reset the clock? Yes. A run-up that pushes the company's market value of listed securities back to 5 million. See, I don't think that MVLS includes restricted shares or employee insider options, etc. But anyway, that'll be something I'll have to look into. It's market value of listed shares, securities. Anyway, if it pushes it above 5 million or higher on even one business day, this interrupts or resets the 30 consecutive business day count. So you could see volatility in stocks just for a day. I don't know how you trade them, but you can see it. How the clock works. The delisting trigger is specifically 30 consecutive business days with MVLS below 5 million. MVLS is calculated each day as the consolidated closing price times total listed shares outstanding. Because the days must be consecutive, any single business day on which MVLS equals or exceeds 5 million breaks the streak. The count starts over from zero the next time it drops below the threshold. This is why temporary price spikes or share issuances that increase the share count enough to lift the product above 5 million are useful for microcaps hovering near the line. They can stop the 30-day clock from completing. Once the full 30-day consecutive has passed or elapsed, the staff delisting determination can still be issued and issued with no automatic cure period. A later run-up does not reverse that. On appeal, simply getting the MVLS back above 5 million is generally not enough. The hearings panel typically requires the company to show it meets stricter initial listing standards, and any exception is discretionary and capped. So this gives an incentive to try to spike it before the staff delisting determination is issued. As of July 29, 2026, the rule itself was automatically stayed pending further SEC review after petitions were filed, so the requirement is not currently operative. So I asked, can it be stretched out indefinitely? Yes, in theory, it can be stretched out indefinitely. And no, it's not the regular closing last sale price. MVLS is calculated using the consolidated closing price, not the last trade official closing price that most people see on Yahoo Finance, Google brokers, etc. The consolidated closing price per rule, NASDAQ Rule 505, times total outstanding shares of the listed class is equal to MVLS. A single higher trade does not help if the closing bid stays too low. In thinly traded microcaps, the bid can lag the last sale, so the direction matters. Under the plain language of the rule, the trigger is 30 consecutive business days below 5 million. Any single business day on which MVLS is greater than or equal to 5 million breaks the streak and resets the counter to zero. There is no stated limit on how many times this can happen. So a company that dips below for 20-25 days, then briefly pops above 5 million via a price run-up, share issuance, or a share issuance that increases the share count by enough, or both, can keep restarting the clock over and over again. The NASDAQ has general authority to look at patterns of manipulative or disorderly trading. Once the full 30 consecutive days do complete, the staff delisting determination issues with no automatic cure period. A later run-up does not erase that. On any appeal, simply getting back above 5 million is usually not enough. The hearings panel generally requires the company to meet the higher initial listing standards. As of July 29, 26, the entire rule is stayed pending further SEC review. So none of this is currently operative. Repeated short-lived recoveries above the $5 million MVLS threshold can keep and you go by the closing bid, it can keep pushing the 30-day clock back, potentially for a long time, either until the company stabilizes or NASDAQ gets their final 30 days of being under 5 million. So I said another non-solution solution. Yes, there are several other classic non-solution solutions that microcaps use to temporarily prop up MVLS without fixing the underlying business. Here are the main ones that actually move the needle on the calculation. Remember, MVLS equals consolidated closing bid, not the closing price, plus total listed shares outstanding, including restricted and affiliate shares. But it's not a fully, I guess it's not a FD number. I'll have to look into that because that leaves me wondering. One of the other bits of advice we got said that it did not include insiders, but whatever. Okay, 1, issue plus list preferred stock. So one strategy is create a new series of preferred shares, list them on NASDAQ and sell some, or just have them outstanding. Because they are listed securities, they count toward the total share count in the MVLS formula. This is a pure share count inflation play that doesn't require the common stock price to move very much. Number 2, they can convert debt to equity or preferred to common shares. They can force or encourage conversion of convertible notes, special purpose arrangement notes, or existing preferred into common shares. SPA notes, if I got that wrong, it's SPA notes. Instant increase in the outstanding common share count leads to higher MVLS, very common, right before the 30-day clock is set to expire. Third thing they can do is a warrant inducement or cashless exercise deals. They can reprice or give inducements as an offer to existing warrants so holders exercise them into common. Same effect as a conversion. More shares outstanding overnight, often paired with a temporary price pop. 4, dump restricted stock, RSUs, on employees or insiders. So they can grant large blocks of restricted stock or RSUs. Even while still vesting restricted, those shares count toward the MVLS calculation. Pure paper increase in listed shares. So this is pretty clear that it all counts. 5, continuous ATM at the market drip. Keep an equity line or an ATM facility open and slowly bleed shares into the market. Every share sold increases the share count and can keep the product above $5 million on borderline days. What does not work as a fix? Reverse stock splits do not work. The reverse stock split leads to a price going up, but shares count goes down by the exact same multiple, and the MVLS stays exactly the same. And just announcing, quote, big news without any share count change The pop has to be large enough and sustained into the closing bid. All of these are temporary arithmetic tricks. They reset or delay the 30-day clock the same way a price run-up does, but they usually come with heavy future dilution. So the stock often sells off harder afterward. Exactly, the run-up leads to finance dilute to sell down cycle. So I put up the Citadel buying out of that young hedge fund guy. Unbelievable that people would trust that much money to a 24-year-old. I said, could this be the end of the sell-off? And the answer is no. This is more likely a clearing event, forced liquidation, which helps stabilize or mark a near-term bottom, for the most crowded levered AI names. But it is not a reliable signal that the broader AI sell-off is definitively over. Here's the key context. That's the name of the fund, situational awareness. Well, I'm not sure if he had much of that. The AI-focused fund run by former OpenAI researcher Leopold Aschenbrenner was forced to sell the bulk of its $16 billion in public equities as a portfolio to Ken Griffin at Citadel after heavy losses in AI-related holdings. It had faced pressure to raise capital or sell assets amid the rout. Prime brokers like Goldman, JP Morgan, Bank of America, etc., facilitated the deal. Citadel took the leverage portion. The fund keeps a smaller book, $10 billion, that's Leopold, including private investments such as its Anthropic stake. The fund had delivered extraordinary returns, 439%. That's 4x, 4.5x. You guys expect more in your portfolios, but look how they talk about it here. Extraordinary returns, 4x over several years through the end of June 26 on concentrated leverage bets in AI infrastructure hardware names like Broadcom, Intel, CoreWeave, Nebius, SanDisk, Micron, etc. High leverage, 4x leverage, unbelievable. Turned a sharp July drawdown into margin pressure and a rapid unwind. Remember that. If your account goes up on leverage, at least sell enough to cover your leverage or bring your leverage down to something extremely moderate. This sits inside a broader AI tech sell-off. Global hedge funds facing their biggest monthly drawdowns on record. Asia long short funds down sharply, and crowded long AI infra over short software positioning, amplifying the move via forced covering and selling. You're a little short, aren't you, buddy? Some see it as the end of the sell-off or a bottom signal. Forced selling is finite. Once a large, highly leveraged player and similar peers is cleared out, the mechanical selling pressure eases. Jim Cramer and others explicitly called similar events a clearing event that historically helps put a floor under the trade once the forced sellers are gone. On the day of the report, several of Situational's former long holdings, same names, Nebius, CoreWeave, SanDisk, Micron, bounced hard, double-digit gains in many cases, consistent with relief after a known seller is out. Citadel, a sophisticated multi-strategy shop and cheater, in my opinion, stepping in to buy the book at distressed prices can be read as a vote of confidence that the positions have value at those levels. But here's why the sell-off might not end. One fund's liquidation does not remove all leverage or crowded positioning across the industry. Other funds in retail, including leverage vehicles in places like South Korea, may still be under pressure. The underlying debate continues. AI CapEx, return on investment, hyperscaler spending sustainability, valuation reset after the run-up, and whether recent efficiency gains reduce the need for ever more hardware. Earnings, guidance, and macro factors still matter. Markets can overshoot in both directions. A bounce after forced selling is common. A durable bottom usually needs confirmation from fundamentals, breadth, or a shift in the narrative, or many weeks at the gymnasium, not just the absence of one big seller. Historical parallels, other leverage-driven unwind episodes, for example, show that clearing events often mark local bottoms in the most effective names, but broader sector or market declines can continue if the fundamental or macro backdrop remains unchanged or challenged. Bottom line, this looks like a textbook leverage-driven capitulation for one of the highest profile AI vehicles. It reduces a source of selling pressure and has already coincided with sharp rebounds in some of the names involved, which is constructive for a near-term pause or bounce. It does not by itself prove that the AI sell-off is finished or that valuations have fully reset. Treat it as a possible short-term stabilizing event rather than a definitive all clear. And here's your main man. Citadel buys most of situational stock holdings after air route sources stay. And there isn't any one of you listening to me who doesn't love Ken Griffin and find him a man of impeccable integrity, looking out for you and Yorn. You and Yorn. So anyway, I'm going to quickly go through that article. Aschenbrenner blamed short sellers who targeted the firm's position. You know, they always make fun of that, but I don't think he's wrong. They can sell endless amount of stock punching the F3 button or just saying, oh yeah, we'll get it to you. They don't have to locate shares. They can exacerbate it massively. And I think he's onto something. But anyway, the firm did not respond to inquiries. A number of top Wall Street prime brokers, Goldman Sachs, JP Morgan, Chase, Bank of America, Citigroup, cashed in on the sell-off. No, it doesn't say that. Helped facilitate the deal between Citadel and Aschenbrenner's fund. Griffin Citadel, which has about $71 billion of assets under management, is one of the world's most profitable and largest hedge funds, probably because they get to front run the order flow that nobody else sees. That's my opinion. Using nanosecond algorithms. But I don't know. That's my opinion. Maybe he does it because he's particularly smarter than everybody else. As part of the deal, Citadel is picking up the portion of Situational's public portfolio that was financed by leverage from brokers. They said Situational will hold a book of roughly $10 billion after the deal, comprised of stocks as well as private investments in companies like Anthropic. Situational has not sold its stake in Anthropic. I bet it will have to. I bet it's going to have to. AI meltdown. Now, AI, they use this. This is not Railtown, but let's see what it says. Global hedge funds are grappling with their biggest monthly drawdown on record as AI stocks have been routed across the board, erasing much of the gains from crowded bets in the sector. Asia-focused fundamental long-short funds are down 18.6% on average this month through July 28. Goldman Sachs said in a prime brokerage note sent to clients this week. Stock-picking hedge funds have been rushing to unwind their positions in AI names before they have to report to their clients. They'd want to look smart so they don't lose their clients. And July, I guess, July 28th is the end of the month. I don't know the particular deadline other than that. So they've unwound as they covered short position and sold long position in relatively equal amounts, according to a note from Morgan Stanley's prime brokerage unit sent to clients on Wednesday. Hedge funds typically take on large amounts of leverage from lenders to take bigger swings at the markets in order to amplify their returns. However, such leverage bets can backfire when the markets move against positions taken by funds, forcing margin calls from prime brokers. That can result in a vicious cycle where the margin calls trigger sales, extending market downturns that beget more selling. Summary. So this is, I guess, the start of that article. Situational awareness. It's a different article. Anyway, situational awareness, an AI-focused hedge fund run by former OpenAI researcher Leopold Aschenbrenner, sold the bulk of its stock portfolio to Ken Griffin's Citadel after being battered by heavy losses in its tech holdings. Two sources familiar with the matter told Reuters on Thursday. Situational was forced to unwind most of its public equities portfolio, which included sizable holdings in several prominent AI names that have been rocked by the recent market sell-off, sources said. The fund was under pressure to either raise fresh capital or offload its entire book, and eventually chose the latter option. Prominent tech names like Broadcom, Intel, and CoreWeave. Since the fund's launch in 2024, Aschenbrenner garnered a cult-like following among investors for his prescient bets on the AI sector that propelled his fund to a lofty 493% return from the start of the year until the end of June. So that's only 6 months, up 4x. But that's huge. But live by the sword. The fund was down 67% so far in July after incurring heavy losses on AI stocks, according to the Wall Street Journal. who saw a letter. It is not clear whether Ossenbrocher's fund faced margin calls from its lenders before striking the deal with Citadel. The hedge fund, which earlier managed about 20 billion of assets, and so was levered up to 45, I guess, and currently has about 20 employees, has used leverage to boost its positions. Aschenbrenner's success attracted big name backers like the secretive trading giant Jane Street, also works with shorts, we call them. Other investors include Stripe co-founders Patrick and John Collusion, as well as Meta Platforms executive Daniel Gross and Nate Friedman. And that was written by Annabir Ban Sen. Let me just see what's up here. All right, I'm going to leave that alone for now. I'm going to go to your comments because I asked for them. Afternoon, William, Kuda Guy. Afternoon, William and RT Crew. Hi. Ward Richardson. Sunday fun fact: 23,724,613 shares times $55 equals 1.304853.7.5 billion smackers. Do you see why people are sucking up to you and trying to become your friend? That's going to be a lot of money. And if we can stick together, we can go after deals. We can go after positions as a fund. I'll show you how to do it. I'll encourage other people to fly with me and meet with me. I'm not a hog, because hogs get greedy and pigs get greedy and hogs and pigs get eaten. Unless you're in a part of the world that you can't do that. But you get the point. Exactly. So our almost 24 million shares could be worth 1.3 billion. Guys, if we stick together, we can make some things happen. Kudakai, wish I could buy my Railtown and my 401. I would be up there with you big boys. Well, I know that feeling. I wish I had a 401k. I wish I had the equity from my house. But the best thing to do is be grateful for the shares we have, and it'll change. Railtown will uplist at some point, and maybe you can buy fewer shares, but you can make a commitment at that time that other people can't. So hang in there. Harbison, I've been deep diving the move away from now you're going to show that I don't understand anything about engineering in software, but I'll do my best. I've been deep diving the move away from vectorization in RAG, which is random access G. RT is really disruptive in this space. Know what you hold, folks. So this is great news. Maybe you can send me something on it, or maybe Ward will be able to tell me what vectorization in RAG is and why Railtown is moving away from it. Harbison, EU AI regulations go into effect today. So from here on out, you must, or one or an entity must explicitly inform users that they are interacting with a machine rather than a human. It's not obvious, I guess. Harbison, the EU Act, AI Act, enforces steep financial penalties calculated as a percentage of global turnover. The real value of an observability and ingestion stack like Grailtown isn't just in building the AI, Harbison. It's in proving to regulators that the AI is doing exactly what you claim it's doing and finding out where it went wrong to fix it in real time, by the way. You're exactly right, Harbison. Exactly right. Harbison, your posts are spot on, well said. And Ward's correcting my arithmetic? How dare he? How dare he? Let me just check this out. So that's a million. That's a billion. Wow. Ward's right. Ward is right. My gosh. Oh, Lord, my God. I stand in awesome wonder of all the worlds thy hands have made. Ward is right. 23,724,613 shares times my target of $55 is equivalent to all of us collectively controlling 1,304,000,000,000. Sorry, I don't think you're right. I think it's billion. Let me just look at that. That's 4 million. I think it's billion. I don't think it's trillion. I think it's 1,304,853,715. It's billion. Still a lot of money. If it goes to 500, we've got a trillion. And it could. It could. All right, let me keep going down the Sunday. Sunday is a fun day, a fun day. It's not just a football day. All right, let's keep going. Okay, you guys are about, with me, you are about to understand the mechanics of these markets better than anyone that you know, unless you know Gary Gensler. But I'm not even sure he knows. Now what I did is let me make sure it's here before I tell you I did it. Yeah, there it is. Okay. So I asked a question of Grok. I don't know what to call Croc. Maybe the Afrikaner maybe is a good nickname. But let's dive in. Let me first check what comes before. Okay, that information was all about NextBridge, and I don't really want to go down that road. So let's go. I'm sorry, I'm having a hard time finding where to start. Let's see right here. Oh my Lord, my God, I stand in awesome wonder. Oh, this is the convertible note. Why don't we do it? Why don't we do it? We'll go down it. I didn't know this is here, but why don't we do it? Okay, so let's talk about Lynn Partners and their financings. So the Lynn Partners convertible note portfolio, a forensic outcomes data set, 2019 to 2026. And I know this isn't going to be complete because it was a lot of work. But across a documented sample of 19 United States and Canadian listed companies who took senior secured convertible, such as floating price repayment, floating price repayment notes from the Lynn Partners Fund vehicles between 2019 and 2026, the outcomes are sharply bimodal. A minority, 3, Golden Matrix, Neocorp, and GSE Systems, repaid in cash or exited the note whole, while at least 4, Silos, Airwinds, BioLays, Parts ID, reached bankruptcy, and several more, Com Sovereign, Blue Star Foods, Blue Star Lakes Tuna, were delisted to OTC, with reverse stock splits extremely common among the distressed names. In the Lynn partnership deals, the recurring deal mechanic is a note issued at an original issue discount, commonly 17 to 20% OID, with a high fixed conversion price plus a fallback repayment in shares formula of, listen to this, why anyone would sign this, except I guess out of desperation, of 90% of the average of the 5 lowest daily VWAPs during the 20 trading days before issuance. Why you wouldn't renegotiate that to, I don't know. I think that anything is bad, but do it for 5 days. Do it for 3 days prior to when they call you, or I don't know. Do a random, because what they're going to do here is just sell for 20 days. they're going to put the machines on overload. But anyway, so the recurring mechanic in these deals is a fallback repayment in shares of 90% of the average of the 5-day lowest VWAP, volume weighted average price, during the 20 days before issuance, a structure that mints more shares as the price falls. Among distressed borrowers, this coincided with a 1 for 20 to a 1 for 100 reverse splits and NASDAQ New York Stock Exchange deficiency notices. Of course it would. And then there's a live out of sample case, which is currently going on, which is Nextrip. Nextrip signed a $4.6 million face with a $4 million funded note with Lind Global Fund 3 on July 21, 2026 at a $3.88 fixed conversion price. You got to be, when they say that, you got to look at the details. But uniquely, as I found out in this note, there are some changes in the document. But anyway, so this was signed July 21, 26 at a $3.88 fixed conversion price, while the stock closed near 192, a substantial premium, with the first monthly amortization of 14 installments of $328,571 due 120 days out in November of 2026. My opinion, and we'll see, I don't think that fixed conversion price, it stays fixed in all situations. So we have to check, is there a path that it stays that way? And I think the machines just start selling. And, you can't prove it, but I believe Lind Partners works with the Toad. And in the background, the Toad provides the money. And in the background, the Toad just obliterates the reg show exemption. So I'm not surprised that the $1.92 is now $1.60. But depending on how the document's written, there may be an opportunity there. My skepticism is they're going to drive it down, try to drive it down to $1 or lower. But we've got to find out, what are the offsetting opportunities on it? I don't know. Let's keep going. So the key findings on this analysis: the counterparty roster is large. According to Edgar, the SEC, for Lind Global, one returns 416 Form 8K hits and 2,233 filings overall, with Lind Global Fund 2 LP named in 349 filings and Lind Global Macro Fund LP named in 96. The most heavily represented issuers include ABVC Biopharma, Parts ID, small I, isn't that clever, Boxlight, Celos Therapeutics, GSE Systems, COMS Sovereign, Airwinds, Blue Star Foods, Blue Star likes Starkist Tuna, Red Cat Holdings, Neocorp, No Labs, Volition RX, Finger Motion, Golden Matrix, Alnos, BioKey, Pax Medica, Stardust Power, Iridex, and Nextrip, period. Lynn Global Fund 3 LP, the newest vehicle, appears in 2025-2026 filings for bionanogenomics, Enveric Biosciences, Fibrobiologics, DefSec Technologies, iVidia Solutions, and Nextrip. The Lynn Partners' own boilerplate, it's verbatim in, for example, the Golden Matrix July 2024 release. Lynn Partners' own boilerplate states, quote, having completed more than 200 direct investments totaling over US $2 billion in transaction value, Lynn's funds have been flexible and supportive capital partners to investee companies since 2011, unquote. I think the toad's behind a lot of that, and the capital is churning, so 2 billion sounds like a lot, but I don't know. If you guys want to read that as something positive and they're good guys, I think they're hard money, and any CEO accepting money from Lynn Partners has to know that they ain't your friends. That's my opinion. So they completed more than 200 direct investments totaling US $2 billion since 2011, with direct investments ranging from under 1 million US to 30 million US, and it's now marketed as up to 50 million. So the standard structure that Lynn Partners uses, Lynn notes across issuers share a template. To wit, it's a face and principal amount set above the cash funded. So it's an implicit OID. For example, Golden Matrix was funded at, quote, principal amount less an original issue discount of 20%, unquote. And Native Mineral Resources' third note carried a 16.7% OID. So they're typically set up with an original issue discount. They're typically 0% stated interest, at least at the beginning, and a 24-month, sometimes 18-month maturity. Monthly amortization beginning 120 to 180 days after funding. Well, that's when the shares that you've set aside can become tradable in the United States. But, you know, if you expect someone like the toad to follow these rules in a world where Reg Show exists, I don't know, you're expecting a lot. But let's strictly take it at face value. Standard structure includes a company right to repay in cash or registered shares. Okay. And critically, when shares are issued by a company, the repayment price is typically 90% of the average of the 5 lowest daily VWAPs over the prior 20 trading days. No one sees that the market isn't real and that guys like the toad, and you can read all about the toad at Market Frauds. This is Andrew Left and the Anson funds. You know, they have an incentive to drive it down. They work, you know, they appear to work together. You can't prove it, so it's just opinion. Notes are senior secured. No, typically Lynn notes are senior secured by a lien on all assets, and Lynn receives warrants. Many notes carry a nominal or fixed conversion price set at a large premium. Boxlight, $3.50. Sayata, $10. Golden Matrix, $4. Described as a, quote, 130% premium over the closing price. Next Trip is an example here at 388, plus a reset. There you go, a reset to a floating VWAP formula if the market cap falls below a threshold. In the case of Boxlight, it was below 50 million. In the case of Boxlight. So the outcomes are, as stated before, are bimodal. And I assume that's kind of on-off, kind of one way to t'other. That's what I assume they mean by that. I assume that's what they mean. But there's some in between. But it's basically most companies get destroyed. And there's no pretty way to sugarcoat that. There just isn't a way to sugarcoat that. So the outcomes are bimodal. In this documented convertible note sample, it's 19 companies, those who experienced a clean cash repayment and a whole exit. And the key here is to notice that 3 companies were able to do this. So this was a matter of convenience, running up a high-priced credit card, because they had a strategy. It's their use of proceeds, and it's what they do with it. And they knew what they were getting in, and they got out. They had a strategy to get out. So anyway, under the clean cash repayment or whole exit, Golden Matrix prepaid the $7.2 million balance of its July 2024 $12 million Lynn note on April 28, 2025, entirely in cash, with no shares issued and no prepayment penalties. NioCorp satisfied its April 24 $8 million notes, co-held with Yorkville, another swell source of funding, funded at $6.960 million. By February 10, 2025. So they paid the full par. They only got just under $7 million, leaving its balance sheet clear, quote, of all long-term debt. GSE Systems repaid its Lynn notes in August 2024 and was taken private by Pelican Energy Partners in November 24. Now, what I would note about these is just because a company gets that paid off doesn't mean they get away from the toad or someone like the toad. If you have a hedge fund dedicated to stealing your entire market cap, in my opinion, it's all done in the dark, you can't prove it. These steps may or may not help, but if the reason you were able to pay these out was because of revenues or a big change in your valuation, or in the case of Pelican Energy Partners, someone bought you out, you got away from it. So you were able to use Lynn Partners look at this example. They got 7 million. They paid back 8 million. Well, that's expensive money, but there are no sources of capital anymore in these markets. It's just very difficult. All right, so bankruptcy is an outcome. And in the case of the 19 companies examined here that used Lind Partners as a source of fund, bankruptcy occurred to Selos Therapeutics, Chapter 11 in November of 24. It occurred with Airwinds Technologies, a subsidiary, bankrupt in December of 23. And the company was completely delisted in June of 24. BioLay's Chapter 11 in 2024. Partners ID, Chapter 11 in December of 2023. Well, these basically rescue the Toad, or companies like the Toad, from ever having to buy back, and they never get a closing transaction. They don't pay taxes. This is something that perhaps I would encourage President Donald Trump to look into, rather than bombing deserts endlessly to no benefit. Doesn't he know that the past 3 or 4 presidents did the same thing? This would really change Americans' lives if we fixed it. Anyway, another outcome among these 19 companies is being delisted from NASDAQ to the over-the-counter without going bankrupt. That happened to COSM Sovereign, Blue Star Foods, and I don't know their current status. And then the ongoing, yet to be determined companies are Red Cat, Alnos, Boxlight, AB, Finger Motion, BioKey, plus several Australian and Canadian mining borrowers. And I'm just taking a guess. I would assume these companies are in dire straits because the selling doesn't stop. It just doesn't stop, wherever it comes from. Okay, so the convertible portfolio from Lind Partners, the Lind Partners convertible note portfolio, a forensic outcome data set across a sample of 19 United States and Canada listed companies. And this was selected by what could be found. It wasn't cherry picked by me. That took senior secured convertible, quote, floating price repayment, unquote, notes from the Lind Partners fund vehicles between 2019 and 2026. Outcomes are sharply bimodal. A minority, Golden Matrix, Neocorp, GCE Systems, repaid in cash or exited whole, while at least 4, Selos, Airwinds, BioLays, and Parts ID, reached bankruptcy, and several more, COM Sovereign, Blue Star Foods, were delisted to the over-the-counter, with reverse stock splits extremely common among the distressed names. The recurring deal mechanic is a note issued at an original issue discount, commonly 17 to 20%, I assume annually, but it doesn't say that here, with a high, quote, fixed conversion price, plus a fallback repayment in shares formula of 90% of the average of the 5 lowest daily volume weighted average price during the 20 trading days before issuance, a structure that mints more shares as the price falls. Among distressed borrowers, this coincided with splits, reverse splits of 1 for 20 to 1 for 100, and NASDAQ New York Stock Exchange deficiency notices. There's one live out of the sample case to look at because it's brand new. Next Trip signed a $4.6 million face with $4 million funded note with Lynn Global Fund 3 on July 21, 26 at 388 fixed conversion price, while the stock closed near 192, which is a substantial premium, with the first monthly amortization of 14 installments, each $328,471, due approximately 120 days out in November of 26. So the thing is to find out, however improbable, does the Next Trip deal, and it has been modified. It doesn't have everything in it the standard Lynn Partner deal does. Does it fall in the 3 who escaped or the rest of the distressed? So the key findings, there's a large counterparty roster, which we went through. There's thousands of filings, and it's claimed to be over $2 billion in transaction volume by Lynn. The standard structure we went through, outcomes are bimodal, just to review. Golden Matrix, Neocorp, and GSE Systems walked away free, although it was expensive in terms of cash. Bankruptcy, several went bankrupt. Delisted, several, it looks like, or at least 2 went bankrupt, and there's some that are out there still. Reverse splits and deficiency notices cluster among distressed borrowers. Among the documented sample, reverse splits within 24 months, only 2 years, of a Lynn deal include Celos, 1 for 30 in November of 23, Airwinds, 1 for 100 in April of 24, COMS Sovereign, 1 for 100 in February of 23, Blue Star Foods, 1 for 20 in June of 23, and 1 for 50 in May of 24. I guess that's a lot. Anos, 1 for 5 in December of 23, and 1 for 5 in June of 25. Boxlight has done a 1 for 5 in February of 25 and a 1 for 6 in June of 26. NASDAQ and New York Stock Exchange deficiency notices, such as minimum bid price. And remember, it's my opinion, groups like the Toad are working in the background to make sure that bid price goes down, or stockholders' equity, preceded delisting at Airwinds, Comms, Blue Star Foods, Celos, and Parts ID. I personally don't see why a CEO would take a Lynn note without making sure their attorneys made changes in the document and without knowing what their strategy is. If it's just a matter of limping forward for 5 or 6 months, I don't know why they do it. But CEOs as you're about to find out, have a mandate that's counter to your interests, in my judgment. All right, so let's just keep going. So here's the deal level with Next Trip. These are several of them. Next Trip is a live case. The deal started the special purpose agreement, or the share purchase agreement, was dated July 17, 2026, and it closed July 21. It was announced July 22 of this year. The source of this information is an 8K and other filings. The counterparty is Lind Global Fund 3. The face value is 4.6 million, and the funded amount is 4 million. So it's a $600,000 OID. There's a commitment fee that goes to Lind, I guess, at 120,000, and it was deducted. So the net proceeds are approximately 3,880,000, and there's no interest, or at least at the start. The repay is in 14 monthly installments of $328,571, beginning 120 days approximately from issuance, basically November 2026. Now, Lind may twice elect to raise a monthly payment up to, anytime during that, they can ask for twice during the 14 months to raise the monthly payment up to $750,000. When do you think they'll do that? The fixed conversion price is $3.88, $3.88, with a full ratchet down round protection. So it's full ratchet down round protection. And what does that mean? Roughly, it means, broadly, it means if the company raises money at a down price, that changes. That fixed conversion suddenly changes. So repayment per share price is equal to 90% of the average of the 5 lowest VWAPs during the 20 trading days prior to payment, almost certainly guaranteed to be ever lower. Cash option, you can pay back at 104x the payment. So it's interesting. It says there's no interest, but 104x on an original issue discount seems like commish to me. And I calculated, I don't know if it's going to be here, and we'll go over, I thought we'd go over this tomorrow, but it's basically, if they pay all cash and they never touch shares, it's like a credit card, 28%, 30%, 32%. It's hard to calculate because the principal amount keeps changing. But it's something like that, roughly 30%. It's expensive, but at least you have your cash quickly. And if you can exit without issuing shares, even if your share price is down for a while, I would argue you can snap right back in price depending on what you use the money for. So anyway, let's keep going. So they have a cash option at 104x the payment. There's warrants for 1,030,928 shares at $388 for a 5-year term. And, that's not much coverage, but it's some coverage. I don't personally think, Lind ever holds on to that stuff, but it's a limited amount of warrant coverage. I haven't studied and thought through the mechanics of it. So let's save that. If I go over it tomorrow, we'll talk about that. First priority, lien on all assets. And you have subsidiary guarantees and equity pledges. There is a beneficial ownership cap at 4.99%. That's so they don't have to disclose anything. And it's up to 9.99%. There is this NASDAQ Rule 5635D cap of 19.99%, but attorneys get around it. The attorneys are always one clever step ahead of their future partners working at NASDAQ and the SEC. Next strip's closing price was $3.10 to $3.20 6 months before they signed this deal. And then it was $2.50 to $2.70 3 months before, so late April this year. And it was $1.92 at signing in July. My argument is, but nobody seems to be able to prove it, is groups like the Toad sell it down. And then that capital is what's given to the company. So the company is just given their own cash. And I've watched this in practice over 25 years. It's just the abuse has gotten worse and worse. Okay, so it's a clear accelerating decline. The $3.88 conversion price was set at a substantial, essentially 100% premium to market, which CEO Bill Kirby characterized as giving, quote, the ability to repay the financing entirely in cash without requiring conversions, unquote. I've spoken many, I don't know, not a handful, I'd say 3 times with the CEO over the last 2 years or so. I'll try to find out when I first did, but I believe he's being truthful in that. But the thing we've got to check, there are mechanisms in there that can change that. So it's based on meeting the company's obligations. The shares outstanding were 14,919,927 as of July 14 this year. There's no explicit floor price in the 8K. So it's still outstanding and outgoing, and we'll see what happens. Boxlight Corp, this is First Lynn Capital, First Global Macro Fund. The note was March 22, 2019. It's restated to 4.4 million in February of 2020. And then there was a separate note of 825,000 February 4, 2020. 8% APR, $2.5 a share fixed conversion, and you get 18 monthly installments. So the $22 million note in September 2020 was funded at $20 million at 3.5 conversion, 4% interest. But then there's a reset to 90% of 5 lowest VWAP formula if the market cap falls below 50 million. There's a commitment fee of 400,000 plus 500,000 in bonus shares. And then they did go through the reverse splits, 1 for 5 in February and 1 for 6, which collectively I think is 1 for 30. They were both needed to cure the NASDAQ $1 minimum bid. So it's ongoing distress. And I believe I can't prove it, it's my opinion. I believe one of Lynn Partners' main go-to investors is the Toad out of Toronto. And the Toad keeps the pressure on. Selos Therapeutics, convertible note, November 23, 21, $20 million private placement, prepayment conversion at $6 in certain circumstances, amended repeatedly. So we don't want to see up here, we don't want to see amendments. They did a 1 for 30 reverse split. It was delisted to the OTCQB. And then it went Chapter 11. And the assets were sold for around $22 million. And obviously they owed Lynn probably close to that $22 million. So it's a wipeout. GSE, it looks like it. You got to do your own research. GSE Systems, 5 3/4 note, February of 22, but only funded $5 million approximately net. Lynn Global Partners 2. The conversion, they always use this fixed language, 1.94 fixed in 18 installments, and they get a big warrant at 194. And I guess they added to the note 1.8 million in 23 and probably changed some of the terms. My opinion is those fixed conversions, there's nothing fixed about them. It just makes a nice press release. But you got to have your own opinion. So then there's INOS, I don't know how to pronounce it, senior secured note of 1.75 million. They had to do, the conversion was fixed at 750, but that's split adjusted. So they already had to do a reverse split, 1 for 5 in 23, 1 for 5 in 25. And I think that's essentially 1 for 25 all in. They're still listed, but it's in ongoing distress. Red Cat Holdings, their share purchase agreement was dated November of 24 for 7.2 million. And they funded approximately 6 million. So that's a huge discount plus fee. 18 monthly installments at 400,000, and it can increase to 750 a month. They got a bunch of warrants at 920. They added a note February of 2025, 16.5 million, which was funded at 15 million. That was a different global Lynn. It was the Lynn Global Asset Management 11 fund, as opposed to the Lynn Global Asset Management 10 fund. They got warrants there. 952 conversion. Now, the business did scale sharply. So revenues increased to 40 million. It was up 460% year over year from 7,000,028. But the net loss widened. So the outcome is ongoing. And so far, equity holders have not been impaired. So that's something to bear watching on Red Cat Holdings. Neocorp Developments, $8 million aggregate notes, April 11 to 12/24. They only funded 6.96. It was co-purchased by Yorkville, a name you're always excited to see in any financing for any microcap. And Lynn Global Fund 2, they got warrants. All obligations were satisfied in under a year. So it was a clean repayment. That's good to see. Expensive, but clean. Sayata Mobile, $7.2 million note, October 27, 21, funded only $6 million. Different fund, Lynn Global Partners 2. $10 fixed, it's always fixed. Conversion, 18 installments starting from 6 months. Because that's when the slug of stock that's sitting at the transfer agent actually becomes convertible. It's got restrictions prior to that. But that doesn't stop the toad, in my judgment. Doesn't stop the toad. And then they've got a VWAP on a $2 floor. So you've got a $10 fixed conversion and a so-called $2 floor, which I wouldn't trust either. So the first default event appears to be December 3, 21. They took the money October 27, 21. What CEO couldn't predict that? Unbelievable. But it was cured on December 7th, 2021, when the market cap exceeded 20 million. What's the outcome in the case of Sayata Mobile? It's serial financing and repeated distress. Doesn't sound good. Other confirmed note holders, BioKey International, June of 20, the Lynn Global Macro Fund, ABC VC Biopharma, February 23 with amendments, Blue Star Foods, January 22nd, a 1 for 20 and a 1 for 50 reverse split, which I think is simply massive. Reverse split of 1 for 1,000 all told. Delisted to OTC December of 24. Didn't take long on the minimum bid rule. Finger Motion, August of 22 and April of 23. And we know they still had something out because in the Wydell financing for Finger, it included a payoff to lend, I believe. I don't think that's in the record. Finger Motion, August 22 and April 23. Pax Medica, February and September of 23. And they have a 301 deficiency item. And then there's a bunch in Canada and Australia. 3 successive convertible security funding agreements at Lind Global Fund 3. And it's very hard to track all this. In some cases, a clear serial refinancing. But I assume everyone here and anyone listening is not in Australia. So let's just move on from that. So a summary of the statistics. These are recoverable samples, not the full Lind Partners book. And it's not completely documentable. So it's estimated. But anyway, in general, out of 19 deals, the stock of the 19 deals declined in the 6 months before signing. What is that? That is either Lind or someone on behalf of Lind, I think in collusion, but it might be separately. They just see the trend, selling like the toad, selling the shares for 6 months under reg show, underlying, it just under the general ability to get away with it, and then being the investor that gives money to Lind under these notes, and the company gets their own cash, which was minted out of retail. That's how I see it, but that's an opinion. All right, so it's documentable and declining in the large majority of the distressed names. All of the ones we named, including NextStrip. The precise 6 months pre-signing closes were not recovered for every issuer. NextStrip's is the cleanest documented case. It went from $3.01 to $1.92 over 6 months into signing. I'd like to find out what the average volume is if we could find it out. We can't with shadow trading, I guess. But I just think NextStrip was given its own money at closing. That doesn't mean it's going to continue to be in trouble. It's just the mechanics of how the junior markets are treated under every president since Bill Clinton. Reverse split within 24 months of a Lind deal. It happened in at least 6 out of the approximately 19 documented names. We went through someone, roughly a third. Delisted or bankrupt happened to 6 out of 19, roughly 1/3, and it might overlap. Clean cash repayment or whole exit, only 3, but 3 did get away. Golden Matrix, Neocorp, and GSE Systems, 1/6. And so the median 12-month post-signing return is impossible to compute. Directionally, it was strongly negative for all the distressed companies. Strongly negative. And it was positive for the exceptions, Golden Matrix, Neocorp, and GSE, and it looks like one other there, RCAT. The distinguishing variable is brutally simple once you line the escapees up. Every clean exit had a dated source of cash that existed independently of the stock price. So every clean exit had a source of cash that existed independently of the stock price. Remember that. Every casualty had only hope and the equity market. Only hope. That's the whole taxonomy, which I think is something to do with putting what you kill, stuffing it, and putting it over the mantle. Look, I'm not a hunter. Look at what each escapee was actually doing with the money. Golden Matrix did not borrow to survive. It borrowed to do something. Remember that. Golden Matrix borrowed to do something. It borrowed to buy something. The $12 million note funded the Meridian Bet acquisition, a profitable cash-generating gaming business whose own operating cash flow then serviced and ultimately prepaid the note. The loan bought an asset that paid for the loan. Beautiful. That's a strategy. It's expensive, but it's like hard money in real estate development. It's like any one of us using 2 or 3 credit cards to get through to our next bonus or our next commission check. We have a plan. Neocorp's notes were bridge paper in the literal sense, co-invested with Yorkville while the company worked through the Ex-Im Bank financing process for Elk Creek. The notes spanned a gap between today and a scheduled institutional funding event. Now, in retrospect, there's no risk there, but I don't know if Ex-Im Bank is any faster than Canada or the World Bank. There was probably some risk that the Ex-Im Bank would take longer than they said, but it worked out. It worked out. GSE Systems had actual operating revenue from nuclear services, and ultimately from a private equity buyer. So they had revenue and they had a private equity buyer. Pelican didn't flinch at clearing the Lynn balance because $5 million is nothing against a real acquisition. And then Red Cat, the ongoing case that hasn't been impaired, revenue went from $7 million to $40 million on the Army program win. The stock re-rated, and suddenly the company could raise ordinary equity at prices that made the Lynn paper trivial to manage. 4 escapees, 1 pattern. Acquisition cash flow is 1 pattern. Government financing is another. Thirdly is a strategic buyer. And fourthly is a contract-driven revenue inflection point. In every case, the repayment cash had a name and a date. It did not depend on the share price cooperating. And I think this is something that would be interesting to find out in the next trip case. So there is a formula, I guess, to get out. Now flip to the casualties of Lind financing. Stelos borrowed $20 million to fund clinical trial burn, cash out, but with the repayment source being, quote, positive data someday, then a financing, unquote. Obviously, that's not from the company. Parts ID borrowed to cover operating losses in a declining e-commerce business. So why did Lind fund these two? My opinion is that Lind has a deal with the Toad or companies like the Toad because they can make 50, 100 million by stealing the whole market cap in the shadows. But that's my opinion. I can't, I think by definition it's not provable. But I don't know why Lind would enter into deals here otherwise. But yeah, that's up to you. Airwinds was funding a flying motorcycle prototype. What a great strategy. Blue Star was funding losses in crab meat. In each case, the only path to repayment was the equity market itself, which isn't going to happen. So why do you think Lind enters into it other than the retail volume giving a source of money that their partners like a Toad, in my judgment, can just take out of the market? They can steal the entire market cap on the way to oblivion. It's, to me, it's obvious, but you can never get anybody to see it. So Airwinds with a flying motorcycle has to, or Blue Star and Crab Meat, in each case, the only path to repayment was the equity market itself. Either the stock price rises and the note converts happily, or the company issues repayment shares at 90% of the lows and the machine grinds. So here's the key takeaway. When your repayment source is your stock price, the note and the stock are locked in a reflexive loop. And the loop only spins one direction for a company with no revenue catalyst on the calendar. So the answer to your second question, why take the loan if you could repay it quickly anyway, dissolves the paradox. The escapees weren't borrowing because they were desperate. That's the key right here. The escapees are not borrowing because they're desperate. They were borrowing because Lind is fast. That's the product Lind actually sells. And it's worth being fair about it because it explains the whole business model. Excuse me while I take a deep breath. And it's worth being fair about it because it explains the whole business model. A bank won't touch a 27 million market cap company. They're just abandoned. A marketed equity deal takes months, a roadshow, and a 20% to file the file to offer discount. It's expensive and it takes time. 20% file to offer discount. And months and a roadshow cost. And at the money dribbles, Lynn, so if you do an ATM, you just get your money with the volume. You got to have somebody out there pumping it up. So there's some volume to take, and you pay your banker, overpaid wanker. So Lind, though, closes in 2 to 3 weeks. But notice the process starts 6 months before. So somebody in the background, in the case of Nextstrip, got the stock down from 320. I think it said 180, 160. Well, all that money they got out of the market, in my opinion, by exemptions under the market maker rule and other just, I think, lying, by selling, perhaps hypothecated and rehypothecated shares, but they collect the money in a prime broker's account. They move the failure to delivers down the road, maybe with synthetic deliveries, and then they can cover here if they ever intend to cover. I question that they do. But in the case of the survivors, they have to have a strategy to cover because the survivors are not depending on the stock price to pay back the note. The survivors have a strategy and they use the money from Lind because it's quick. And it acquires something or does something that creates value above and beyond the OID and the extreme, nearly illegal price cost, but just under. Okay. Lind closes in 2 to 3 weeks, no shareholder vote. No syndicate, wire on Friday. For Golden Matrix, that speed meant making an acquisition deadline. For Neocorp, it meant not stalling a construction timeline while a federal process ran. They paid 15 to 20% original issue discount for the certainty of timing, which is, when you think about it, a rational price when the money is buying a scheduled asset, and a catastrophic price when it's buying 18 more months of hoping, 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 and hoping, and hoping. And we went through these. Airwinds filed bankruptcy, Comms delisted, Parts ID bankruptcy, BioLays bankruptcy, and then Golden Matrix clean payment. We went through that already. I'm lost again. Let me see if I can find out where I am. I'm sorry, this happens more than I intend. More than I intend. All right, I think I skipped one line. Relax, everyone. Relax, everyone. So maybe it goes there, and I just need this. Let's see. Let's see what I missed. All right, I think we can get going. I think we already talked about these, so I'll go through them quickly. But just to make sure, we'll do it. Yeah, we went through the terms roughly, quickly on next trip. We went through these results. And again, results. We talked about, that it was basically most companies did not have a good experience. But there were three that survived, and one looks like it's going to survive. We went through the brutally simple conclusion. Every company that had a clean exit had a dated source of cash that existed independently of the stock price. Every casualty had only hope and the equity market. And then we went through the escapees. The paradox is the companies that escaped this weren't borrowing the money because the company was desperate. They were borrowing because Lind could give the money to them quickly. All right, so I don't know why this is starting here. I must have asked a question. Let's price the next strip deal the way a lender would never write it down. All in per scenario against the 3.88 million of cash Next Strip received, because the 0% interest framing is the anesthetic. The arithmetic is the surgery. The floor, which is the impossible best case, according to this analysis, I'm not sure. We have to find out. I'm not sure that the floor isn't achievable. Suppose every payment is made in cash and nothing else goes wrong. I mean, I would say it's a very narrow path, but Nextridge actually pays 14 times 328,571 times 104. It equals 4.78 million they have to pay back against 3.88 million received. So the cost is 904,000 if they make payments in full, or 23.3% of proceeds. But since the money isn't out for 18 months evenly, the amortization starts at day 120 and runs monthly. So the weighted average life is about 10.5 months on the deal. Annualized, the true IRR of the best case is roughly 26 to 28%. That's the number to focus on. The cheapest possible version of this zero interest note is credit card plus pricing. And it's the version that requires the company to have $4.8 million of cash. It doesn't demonstratively currently have. Well, we got to find out about that. So the realistic case, which is the one I think, is share prices go down for a while, ceteris paribus, unless something else happens. Now the cost has two layers and the costs compound. First, the mechanical spread. Repayment shares are priced at 90% of the 5 lowest VWAPs of the prior 20 days. And the 5 lowest of 20 days sit maybe 4 to 6% below the prevailing price on their own. I think it'll be lower if it happens. So the 328,571 installment delivers roughly 380,000, 390,000 of market value in the stock. The company pays 115 to 118 cents on the dollar if the price hasn't gone much lower in the share path before the price moves at all. Across the full 4.6 million deal, that's 5.3 to 5.4 million of stock. Add the 720,000 already extracted up front. That's the original issue discount plus fee. The embedded gap is they only received 3.88 million, not the 4.6 million they owed. And then you add in the warrant. It has some value, even though it's out of the money at this point. That might be priced 700,000 or so. So when you take the whole value, once you pay it back in shares over time, and not assuming a huge collapse in shares, you pay roughly 6.2 to 6.5 million against the 3.88 million. It's a 60 to 68% cost of funds over 18 months, something like a 40 to 45% payment annualized. So that's payday lending territory, secured by a first lien on every asset the company owns. And this is where I don't think, talking generically, I don't think this should be legal. But as we'll find out today, and I'm going to finish everything I have, The securities laws were written about disclosure, not about a bad deal. So anyway, if this happens, Next Trip will be paying 40 to 45% annualized before the stock goes down too much. So a key question is, are they going to allow it to get into a place where they're paying back the company with stock, paying back Lynn Partners with stock? I think it's pretty clear they intend that that's not going to happen. But we'll go over this again, but it's important to know the parameters. And then finally, there's the spiral case, which is the stock prices going down. So this is the dilution accounting, which is the honest denominator. This is the one to be scared of, and this is the one, without knowing the strategy, I think you always have to fall back to. Here are the percentage stops. Here the percentage stops being an interest rate and becomes a fraction of the company. So the shares out today are 14.92 million. The market cap right now is 28.6 million. So what if the price of Next Trip goes down to 150 through the repayment window, and the formula issues 3.4 million shares? That's 23% of the current base handed over for essentially $4 million. At a dollar average, it's 5.4 million shares. That's 36% of the company for essentially $4 million. At 50-cent average per share, which is what the 14 months of forced selling into 169,000 share average daily tape can do. It's not locked in. The formula wants 11 million shares. So it's essentially issuing 75% of the existing base. And then somewhere along the way, you collide with the NASDAQ just under 20% cap, which doesn't stop the debt. It just converts the excess back into a cash obligation that right now, for all visible information, the company can't meet at a default rate of 120%. And then you add in the warrants plus the full ratchet on top of all of this. So what does it break down to? So the one sentence answer in the ascending order of realism is, if you pay, and they say here, a miracle, the company's able to pay everything in cash. They call it a miracle. I think it's an open statement that I think the company does have a plan, by the way. But that's some of my due diligence to do. So in ascending order of realism, if Next Trip were to pay back its entire owings in cash, it's a 27% annualized clip. If the stock kind of stays where it is, somewhat lower, it's an ordinary share repayment grind, it's about 40-45% annualized. And in the case you consider realistic, he's hanging that on me. I'm not sure I do anymore, but in general, my default position is that if you do business as a CEO with Lynn Partners, to be realistic, you have to assume the toad is involved, and the toad wants your blood. The toad wants your soul, and the toad wants them both right now. but that's just my opinion. Badly quoting Ringo. So the worst case, you have to sell, Next Trip will have to give between 1/4 and 3/4 of the entire company in exchange for essentially $4 million. And the equity is sold via a formula at a valuation for the company between $5 and $15 million. And don't you know they'll want to get it under that $5 million against an already depressed $28 million market cap. So that's the looking at it, defining the worst case. And that's what I think you have to do with investments. You've got to look at it with a cold, calculated eye. But notice it gave you a way out. They called it a miracle, but they gave you a way out if you pay in cash. And so that's the key thing to look into and bear in mind. I don't know what question I asked. Oh, I asked about disclosure. Because the question contains its own answer, and it is the most clarifying fact in American securities law, right here. The 33 and 34 acts don't regulate the fairness of bargains. They regulate the completeness of disclosure. So the job is to disclose everything. Well, I'm not sure they do, but to disclose enough that the regulators see it as complete disclosure. They don't. The law doesn't regulate whether or not the bargain struck is fair. So to go on, there is no spirit being violated because the spirit I'm appealing to, that a security shouldn't be predatory, in other words, that a financing shouldn't be predatory, was deliberately left out of the federal design. Congress in 1933 chose sunlight over merit as a review. Tell the truth about the deal, and you may sell any deal, however ruinous. The SEC has no statutory power to say this note terms are abusive. The SEC can only say you didn't disclose them. Lynn Partners discloses them. Lynn Partners discloses every VWAP formula, every ratchet, every lien is in the exhibits filed and made public. The 8K we dissected is the system working exactly as built. But here's the twist worth understanding. The merits used to be policed. They used to judge the merits. That's back when I was, a minor player out there. By the states. That's the whole blue sky thing. Blue sky regimes in many states practiced genuine merit review and could and did block offerings as substantially unfair. Then NISMIA in 1996, that sounds like Bill Clinton, preempted state merit review for, quote, covered securities, which includes anything listed on a national exchange. So they preempted state merit review for anything listed on a national exchange. Swell. That does sound like Clinton and Rubin. But I don't know that for a fact. So the one legal tradition that could have said, quote, no, this instrument is too toxic to sell, unquote, was switched off for NASDAQ companies by statute 30 years ago in the name of capital market efficiency. The floating price convertible boom of the late 90s, the death spiral era, Hillian and Vermillion documented, followed almost completely. That's not coincidence. That's the regulatory dam coming down whilst Bill Clinton was president. Oh, he was so wonderful. He was such a great president. What's left is patchwork, and each patch has a hole. The exchanges impose the 20% rule, NASDAQ 5635D, which is why the next strip note carries a 19.99% cap. But as we established, the cap doesn't cancel the debt. It converts excess share obligations back into cash obligations the company can't meet. Before I go on, the finger vote just now is to allow more than that 99.99%. So what the cap does, it converts excess share obligations back into cash obligations the company can't meet. Well, in many cases, that's right. Why is that allowed? Why would Lynn sign such a deal? Unless they're doing something with the toad. That's my opinion. Or a company like the toad. At a default of 120%. That protection detonates. So the NASDAQ protection detonates. Delaware, I got to drink something. Delaware fiduciary law theoretically holds the board accountable for signing ruinous paper, but the business judgment rule protects any disinterested board who can say, quote, we needed the money and this was the terms available, unquote, which for a going concern company is always true. And the SEC's one genuinely creative attack on this industry, the Lind industry, came through the side door. The unregistered dealer theory. In the Keener and the Fiero cases, which all of you, I'm sure, are closely familiar, the commission argued, and the 11th Circuit agreed, that funds like Lind, whose entire business is buying convertible notes, issuing debt, and rapidly selling the conversion shares into the market. I got a little clue. Those shares have already been sold, in my opinion, are dealers under the 34 Act, operating illegally without registration. That theory gutted the bottom feeding end of the toxic lending pool, the true penny stock flippers. But note who isn't reached. A registered investment advisor running LP limited partner funds holding 18 to 24 amortizing senior secured notes with resale registration statements properly filed 6 months down the road. Well, who steps in? My opinion, the toad. Can't prove it. I don't think anybody could prove a lot of criminal acts in history. Ask the the Chicago mob guy Capone, how they got him. They never proved anything. They got him on taxes. So Lynn's structure reads like, here you go. Lynn's structure reads like it was designed by someone. Attorneys who studied where Keener died and built 10 feet uphill of the water line. The March 2025 RII registration only formalizes it. The dealer theory catches sharks. It was never built to catch architecture. Now, my cynical read that the 15% retail participation just isn't worth regulating and spending money on it deserves an honest treatment, because the actual logic is different and in its way colder. The regulatory theory says the contract is between two consenting, sophisticated parties. I'm not even sure the CEOs are sophisticated here, because Lind had to hire, or whoever's backing them, maybe the Toad, had to hire the best attorneys available to come up with these workarounds, in my judgment. The regulatory theory says the contract is between two consenting, sophisticated parties, an issuer's board and an institutional fund. The retail shareholder isn't party to it. They are a bystander whose protection is disclosure. That's it. The 8K is filed within 4 days. Read it before you buy. Read it before you weep. The system genuinely believes it has protected the patient's pays poster because the VWAP formula was available on the SEC website, EGDR. That's your 2-finger iPad screenshot, which demonstrates what actually happens. There's a headline on the phone, but the mechanism is in Exhibit 10.2. This is the gap between the law's model of an investor and the living model. I don't know what word to use. In other words, it's moot court versus reality. It's the ideal model and versus the real living world. And there is a counter argument. If you ban this toxic, it doesn't say that here, but if you ban this kind of predatory, it doesn't say that here either. If you ban this paper, the marginal company doesn't get better financing. It ends up getting no financing, and it dies in August instead of December or next December. Well, my opinion, let it die. Somebody has to be last resort capital. Somebody has to price last resort capital. I don't buy this argument, as you can tell. The price will be brutal, whoever sets it, and at least this version is filed publicly rather than done as a loan shark side letter. Well, I guess you don't use a coat hanger, but I really don't know that it can be called capital either. That argument isn't stupid. Well, I think it is. Your data set's answer to it is also fair. Fine. But then the disclosure had better carry the load. And a press release that headlines a never to be used $388 fixed price, while the operative 90% of the Lowe's formula lives in an exhibit in the disclosure regime, That is gaming the system, and it points exactly where it's the only protection left. I don't know about that. I argued in my question this should be illegal, as is my want. Merit regulation is not coming back, not in the blue sky, and it never was there federally. NISMIA and 40 years of policy momentum guarantee it. I've always argued that they got here incrementally, they don't quit. But Rule 10b-5 already prohibits materially misleading framing, not just false statements. And the gap between Next Trip's headline and Next Trip's exhibit is a live specimen of framing doing the work lying used to. I'm not willing to accuse Next Trip of lying, but I blame it on Lind more than on a company. But I'm also saying it needs to be examined. One doesn't have to argue that the paper should be banned. You can argue that the advertisement of the paper already violates the rules we have, and nobody's enforcing those rules. The law asked only for sunlight. They filed sunlight in the exhibit and sold the shade. I think this is a strong representation that I don't necessarily agree with. On the other hand, I think it's something to ask about. All right, I think we're done for now, and I'll go to your questions. Let me just check to make sure. Yeah, we're done for now. Okay, so let me go to, there's only 4 comments it looks like, but I appreciate them. And then I might take a quick break, and I'm going to come back. I've got, I think, 3 more sections. It's 4:30. I've put a hard task ahead of myself. Let's see if I can get it done. Ward Richardson. That's right, William. 1.3 billion. Just checking your reflexes. Railtown strong. Ooh, ooh. Unknown Stuntsman. Hi, Uncle Bill. Buckeye in Puerto Rico. Always appreciate Williams and this community's due diligence. I agree with Harbison. We know what we hold. Exactly. Hold, 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 hold. Ward Richardson. Harbison, the last 2 companies that partnered with IP Partnership are Wiser and Cinchi. Both have disruptive software stacks. They are building a powerhouse of enterprise ecosystem pipeline here. See, I agree with Ward. I agree with Ward. It's raining outside, and I think what I'm going to do is put up my Venmo. Don't go away. I'm just going to put it up while I take a quick break. I might be able to find something to eat. I might not. But I'll be right back, and we'll have more of the Underdog Show. Get some tea. All right. I found pistachios. Yay. That'll give me enough energy to keep going. All right. So I am going to keep going. And we just talked about, in general, and not too much, but we talked about Lynn Partners and their results. Let's now go into the market. Now, I provided, and I'm not going to make you read them, I provided the breakdown of the Lind note, and maybe I stopped too soon on discussion of Lind. So let's finish that up. It looks like I did. There's only a little bit more to go, because I wanted to clarify what the note actually had in it. Maybe I don't remember, maybe my questions were about the specific note. I can't remember. Or maybe not. Maybe this goes directly. This is great. So I did go into, I think what I did is follow up on the Lynn questions, but I saved that for tomorrow. Here, earlier today, I went through, and I'll describe it this way, but I went through, here's my idea. I wanted to see how the 4 main AI companies answered this question. And I didn't try to prod it or anything. I didn't use China's, and I think there's one more out there that's brand new. I just couldn't remember the name of it. So here's the question. What I wanted to talk about, what are the alternatives for CEOs? What is the market like? Why do we go through this? It's very educational, and it helps us know both how we can trade it and maybe just stay away from a big bulk of it. To me, it looks like the 80-20 rule. 80% of the stories you can just write off without doing much study at all. But there is room in 20% of them, it looks like. But let's go forward. So here's the question I asked. Can you give me a primer on how, who, and the mechanics of HFT selling in stocks below $5 and selling under institutional cutoffs for market cap? Can you discuss who bona fide market makers really are? Why should stocks which would otherwise trade by appointment be subject to HFT computerized selling? Discuss how humans, firms, used to provide real market making, real research, and real thundering herds of retail brokers to recommend stocks. Where have specialists gone? The fake, the manipulative research discussed. The front running by Citadel, for example, in order to give quote unquote free commission. The complete abandonment by the SEC of the OTC in terms of monitoring or policing the revolving door at the SEC. Discuss whether the NASDAQ is the jewel it once was, or just a gilded way to strip shareholders of their capital. Is disclosure of risks adequate? Why are attorneys allowed to end run every rule in their attempt to create ATM and toxic financing? Financing which, in simple English, are usurious, but in legalese, they are the CEO's fault. Where can American grassroots companies go to get a fair shake at financing or price discovery? Why do trades occur in the shadows? Why is there not one item that gives retail shareholders standing of any kind in the markets? Discuss the tag-alongs, the sharks that short all of these doomed companies. Discuss how news, press releases, anything good is met with a rush. So many typos in here. Anything good, news, press releases, is met with a rush of buying, and then that buying just feeds the computerized algorithmic program selling beast. It seems institutional buying sustained is the only way out. What causes that institutional buying? A change in NAV, drug approval that is final and big, huge verifiable contracts and revenue? If any news gets crushed by share price, how can an honest group of shareholders help a company get out of this Hades? And I asked the Afrikaner first. This is a big set of questions. This is a big set of questions. And they touch on something many small cap investors have noticed. The market for a $300 million company is fundamentally different from the market for a $300 billion company. Some of your observations are well supported by research and regulatory filings. Others are common beliefs among investors, but are much harder to establish as fact. I'll attempt to separate these carefully and not hurt your feelings. So he starts with the market that used to exist. Sorry, I'm trying to have some energy here. Okay, so he starts by pointing out, if you go back to roughly the 1970s through the early 1990s, which is when I began, not in the 70s, but particularly before decimalization, and that was a big change, and widespread electronic trading, a typical small company had an ecosystem around it. That's gone now. And no one tells you that. No one tells you that. That ecosystem included an ecosystem around a small cap company. That ecosystem used to include, and you've heard me talk about all this, a brokerage firm that underwrote the company, an analyst who actually knew management and the industry. That's gone. Retail brokers who called clients with investment ideas. That doesn't happen anymore. A specialist on the New York Stock Exchange or a market maker for NASDAQ stocks, a human being who maintained orderly trading. Doesn't happen anymore. Institutions willing to accumulate positions over weeks or months. Trading was expensive by today's standards. Commissions were meaningful, then they were. Bid-ask spreads could be 25 to 50 cents. They could be a quarter. They could be half a point. Ironically, the inefficiencies of those spreads is what funded research and what funded liquidity. I was close to the president of a firm I worked for. I was very young. He said he wanted to make me the manager but anyway, he saw very early on that you had to give research for free to be competitive. But anyway, these inefficiencies of these costs and commission, that's what funded research and liquidity. The spread between the bid and the ask paid for human beings. Today's market is dramatically cheaper for investors if you only measure it by commission. But much of that economic support system has disappeared, and I think you're more likely to lose your money. I don't know how to calculate that cost. So where did the specialists go? The old New York Stock Exchange specialist system has largely disappeared. No kidding. New York Stock Exchange still has designated market makers, DMMs, but their role is much narrower than specialists once had. And I've made this argument to you without the DMMs. I've made this argument to you quite a bit. The NASDAQ never had specialists, and I've pointed that out to you too, in the same sense. It had competing market makers quoting prices. You'd have a firm, Raymond James, a Merrill Lynch would make a market. And it was, I think the NASDAQ, if you didn't make a market in the stock, it had some automation to it, but it was mostly people. And then look here. Today, much of market making is automated. Instead of a human deciding, I'll support this stock around $4.75. Now there are algorithms continuously updating bids and offers based on inventory, volatility, correlations, and thousands of other inputs. That makes markets incredibly efficient for liquid stocks. It also means no one is emotionally committed, but not even emotionally, knowledge-based committed to supporting an illiquid stock, which almost every stock we're in would be illiquid if it weren't for the high frequency onslaught. Did I skip too far? I did. I went too far. Okay, so why are high frequency trading firms involved in a $2 stock? This is one of the more interesting questions. Many investors assume high frequency trading only occurs in Apple or NVIDIA. In reality, algorithmic trading now touches almost every electronically traded stock. Why? Because algorithms do not care whether the company is wonderful. Algorithms do not care whether the company is wonderful. They care about spreads, volatility, order flow, statistical relationships, inventory risk. If a $2 stock trades 15 million shares daily, it may actually be attractive from a market making perspective. The algorithm isn't expressing an opinion. The algorithm is monetizing liquidity. Is computerized selling manipulating prices? Sometimes investors interpret persistent selling as evidence of manipulation. Sometimes. The reality is more nuanced. What's the nuance? There are several possibilities. For a stock under $2, come on. AI doesn't always use its brain. So here are legitimate reasons. ETF rebalancing, in stocks over $10. Index deletions, in stocks over $10. Hedge fund risk reduction, in stocks over $10. Tax loss selling, okay, finally hit one. Convertible arbitrage, I'm sure that goes on in everything Lynn Partners does, or anybody else like that, in my judgment. Options hedging, maybe, if they trade options. Quantitative funds, they have these computers going. So these so-called legitimate reasons can create enormous selling pressure that has nothing to do with fundamentals. Nothing to do with fundamentals. Now, there is less benign behavior, according to the Afrikaner. Regulators have brought cases, I don't know if they won them, when spoofing is involved, layering, wash trades, false quotations, pump and dump schemes, manipulative short selling. These activities are illegal. They do occur. But here's the rub. But proving that any specific price decline resulted from illegal manipulation is difficult. And I don't think they even try to. I don't think it'd be that hard if they had an audited trail, or if all trades had to occur on the lit exchanges. I don't think it'd be that hard at all. So what about payment for order flow and Citadel? This is probably the most debated issue in U.S. market structure. Retail brokers offer commission-free trading, partly because they sell retail order flow to wholesalers such as Citadel Securities, Virtue Financial, and others. Now, the wholesalers argue retail orders are generally uninformed. I don't know what that means. About price, and you're going to help us? They can provide price improvement. Investors often receive executions better than the displayed national best bid or offer. Critics argue, the wholesalers see order flow before the exchanges. Yep. Concentration reduces competition. Yep. Price discovery moves away from public markets. Yep. Exchanges become less informative. Yep. The debate remains active. And does this surprise you here? Regulators have examined reforms for years without doing anything, without fundamentally changing the system. Importantly, payment for order flow is not the same thing as illegal front running. Front running generally refers to what Citadel does. Oh, it doesn't say that. I made that up. It's just in my opinion. Front running generally refers to trading ahead of a customer's order using confidential information. Market makers are subject to rules intended to prevent that, although critics argue that informational advantages can still arise from their role. Why can't people just state the obvious? Why does good news often get sold? Small cap investors see this constantly. A company announces a partnership, an FDA milestone, a contract, a patent, a financing, earnings beat, and the stock spikes and then falls all day. Several mechanisms can contribute. You mean other than rigged cheating? Toxic financing. Nope, sorry. I'm supposed to go here first. First, traders who bought in anticipation of good news may simply take profits. Yeah, that's what normally happens. Second, algorithms often supply liquidity into sudden buying, meaning they sell into the surge and buy back later as enthusiasm fails. Well, is that really maintaining a market? Man. Thirdly, if the company has a history of raising capital after positive news, investors may anticipate future dilution. Look, they're going out of the way to try to explain what's happening. Fourth, short sellers may increase positions if they believe the move is overdone. There's no thinking. None of these necessarily imply coordinated manipulation. Though in certain situations, unlawful contact can occur. Well, thanks. Thanks for allowing for that in certain situations. Toxic financing. This is the one area where many observers, including academics and regulators, agree there are real problems. So why doesn't anything get done? Some financing structures contain floating conversion prices, reset provisions, warrants, death spiral convertibles, variable price securities. These create incentives for investors to hedge or short while converting discounted shares. Of course, they leave out the toad. That can produce can produce persistent downward pressure. Now listen to this, if you can. These financings are generally legal if properly disclosed. These financings are generally legal if properly disclosed. The legal documents often warn investors of dilution. Whether those disclosures are sufficiently understandable to ordinary investors is another question. Why do attorneys seem to be able to structure around the rules? Security law often regulates disclosure more than outcomes. If risks are fully disclosed, many aggressive financing structures remain permissible. The board approves them. Even shareholders may vote on some of them. The SEC focuses heavily on whether investors received material information rather than whether the financing itself was economically favorable. Critics argue that this disclosure-based approach can leave retail investors inadequately protected, they argue, when complex financing terms are difficult to understand. Just can't call a turd. Has research disappears? In many ways, yes. MIFID2 in Europe, wherever that is, shrinking commissions and industry consolidation reduced incentives for small cap research. So you don't have anybody putting their reputation on the line. Today, fewer, I would argue any, but fewer analysts cover microcaps, fewer brokers market ideas, any, fewer institutions perform deep due diligence. Many companies under 500 million receive little or no professional coverage. You see that? Instead, investors encounter newsletters, promotional websites, social media, paid research, investor relations campaigns. Some of these are valuable. I would argue in a vacuum, they're more valuable than nothing. Why do trades occur in the shadows? A significant share of U.S. equity trading occurs off exchange through wholesalers and alternative trading systems, sometimes called dark pools in certain contexts. The rationale is that large investors can trade without immediately revealing their intentions, potentially reducing market impact. No, it's hiding what they're doing. That's not supposed to be allowed in price discovery. Supporters say this lowers trading costs. Critics argues it weakens public price discovery. Exactly, because not all trading interest is displayed. You used to be able to tell when someone was buying, and then you joined in or you got out. Critics argue it weakens public price discovery because not all trading interest is displayed on the exchanges. Count me in as a critic. Count me in, Jack, as a critic. And I see no excuse whatsoever none. No, nay, never. No, nay, never, no more. And I search the world over. No, never, no more. So it's no, nay, never. No, nay, never, no more. It's 5 o'clock. Anything happening? Good. Furious RFK Jr. goes off the rails in screaming match with CNN host over some pandemic failings. All right, let's keep going. We're under a schedule. We're under a schedule to perform. All right, let's see. Yeah, we did that one. Good. We did that one. Good. So I didn't get lost. Why do institutions matter so much? One thing you've identified aligns with how markets often behave. Algorithms can dominate short-term price action. No kidding. Long-term trends usually require sustained demand. That demand often comes from institutions, which we are in the case of Railtown. What brings them in? Now look at some of these things. What brings in institutions? Consistent revenue growth. So you got to look for that. Improving cash flow. You got to look for that. Profitability. You got to look for that. Reduced financing risk, which the top three do. Major regulatory approvals. Meaningful commercial contracts. Inclusion in indexes. Increased liquidity. Governance improvements. Got to look for all of those. So you can find something that fits those parameters, and you got a winner. A single press release rarely changes the long-term investment case unless it materially alters expected future cash flow and therefore changes risk. So I asked, where can grassroots companies find fair financing? This is one of the hardest problems in U.S. capital markets. For a very small public company, options are limited. Traditional venture capital before going public, rots a ruck. Private equity for somewhat larger firms, rots a ruck. Strategic partnerships. Royalty financing in some industries, that's in mining primarily. Bank lending if cash flows support it. Rights offerings that allow existing shareholders to participate. And then we have the at-the-market offerings, misnamed, which can be less dilutive than some alternative structured. But here's a key point. If used judiciously, that's a key point. That's up to the CEO. Unfortunately, companies that are already public, companies who have limited revenue, and companies who also face high cash needs often have weak bargaining power. That can make expensive financing terms expensive, more likely, crushing financing terms. Has the SEC abandoned the over-the-counter market? Being AI, this is not this is not the Afrikaner. This is Chat GPT. This whole section has been Chat GPT. Has the SEC abandoned the over-the-counter market? I would frame it more cautiously. The SEC continues to bring enforcement actions involving microcaps, involving manipulation, involving fraudulent offerings. And the SEC has supported reforms affecting OTC disclosures and market transparency. At the same time, many investors believe enforcement resources are concentrated on the largest markets and highest profile cases, leaving misconduct in parts of the micro cap ecosystem under policed. Resource constraints and the sheer number of the cheaters, doesn't say that, the sheer number of issuers makes comprehensive oversight difficult. And then they answered my revolving door question. Movement between the SEC and private practice is real. Former SEC lawyers often join law firms, compliance practices, exchanges, or financial institutions. And private sector experts are also recruited into the SEC. Supporters argue this brings valuable expertise. Critics worry about regulatory capture or conflicts of interest. This debate has existed for decades and extends beyond securities regulation. In other words, nothing is done about it. Is NASDAQ still the jewel it once was? NASDAQ remains home to many of the world's largest and most innovative companies, and its technology and listing standards have helped shape modern equity markets. At the same time, the experience of many microcap issuers on NASDAQ can be very different from that of its largest constituents. Can be thin institutional ownership, limited analyst coverage, frequent capital raises, and heavy quantitative trading really can, shouldn't you say does, create a market environment that feels disconnected from a company's underlying progress. Whether that reflects flaws in market structure, the economics of small company investment, or both, is, of course, the subject of ongoing debate, so nobody has to do anything about it. Can shareholders help a company escape this cycle? Shareholders generally have limited ability to influence market structure directly, but they can sometimes contribute to improving a company's prospects through governance and long-term support. Constructive actions may include voting thoughtfully on directors' compensation and major financing, but how do you have an impact if the number of shares voting has been massively exploded by fraudulent creation of shares in people's accounts? Encouraging transparent investor communication and clear disclosure. Supporting financing structures that treat existing shareholders fairly. How are you going to do that? Avoiding the spread of exaggerated or misleading claims, which can damage credibility with institutional investors. I guess that's something we all can do. focusing discussion on measurable business progress, revenue margins, customer adoption, cash flow, regulatory milestones, rather than short-term price movements. Absolutely. And we do that here. We are not hot money. We are not day traders. Ultimately, the most durable recoveries in small cap stocks tend to occur when the business itself changes in a way that attracts long-term capital. That often means sustained execution rather than a single positive announcement. But sustained execution can be prolonged before the aha moment comes. So you have to judge that execution, even if the market hasn't seen it, quote unquote, seen it yet. Market structure can influence short-term prices, but over longer periods, which may have already happened, companies that consistently grow, improve their balance sheets, and reduce financing risk have historically had a better chance of drawing institutional investors and achieving more stable price discovery. That outcome is not guaranteed, and many promising small companies do still struggle. But durable business improvements are generally more effective than attempts to outmaneuver short-term trading algorithms. And one key thing, even with good news, you cannot have the overhang of toxic predatory financing. I don't care how mealy-mouthed the wording is here. The intent is there, and they do work together, the toad, in my judgment. I mean, you gotta, I don't know, you gotta believe what you see or what you're being told, but I tend to believe what I see. Is the shift of roughly 15% of the market now retail from much higher numbers in the 1980s the problem? I think it's one of the contributing factors, ChatGPT says, but it's not the root cause. The decline in retail participation changed the character of the market more than it alone having caused the problem you're describing. In the 1960s through the 80s, individual investors directly owned a much larger share of U.S. equities. Today, direct retail ownership is substantially lower, while institutions, including mutual funds, pension funds, ETFs, hedge funds, insurers, and other asset managers, collectively own the majority of the market. Retail activity has increased in recent years, but institutions still dominate ownership and trading. The bigger shift, in my view, ChatGPT, is not simply retail versus institutional. It's the replacement of fundamental investors. There are no fundamental investors anymore, whether they're retail or institutional, with systematic trading. Everybody's a day trader now. Think about the different eras, the old market. The marginal buyer, which is who prices things, because people who have already bought have no purchasing power anymore, right? So the marginal buyer of a small stock in the past might have been a local broker who recommended the stock to 100 clients. It might have been a regional mutual fund. It might have been an analyst who had spent 6 months, which you've done in the case of Railtown, might have spent 6 months researching it. Or it's an individual investor willing to own the stock for 5 years. Those buyers were making decisions based primarily on business fundamentals. That's the old market, making decisions based primarily on business fundamentals. The modern market. Today, the marginal trade may come from an ETF creation or redemption, an index rebalance, a statistical arbitrage model. Nice name. A market making algorithm. Nice name for the Grim Reapers. An option hedge, a risk parity fund, an execution algorithm, slicing a larger order. None of these or those participants necessarily, leave that word out of them. None of those participants care what the company actually does. They don't care what the company does. That is a profound change. Exactly right. It is profound. Why this hurts small companies? Suppose a $250 million industrial company reports excellent earnings. 40 years ago, and what's scary is I can remember 40 years ago, perhaps 20 brokerage firms would have called clients saying, this company just earned 40 cents per share instead of 20 cents. We at Dewey, Cheatham, and Howe, we think it's worth buying because it's Smith Barney. We earn money the hard way. That kind of buying could persist for weeks. Today, there may be no analyst covering even a $250 million industrial company, no brokers promoting it, and only a handful of institutions are even able to own it because of liquidity or their mandate constraints. So the immediate buyers are often short-term traders. Once their demand is satisfied, the stock can drift back if there isn't a new class of long-term buyers. Can? It does. It does. So the 15% issue, if retail represents a smaller fraction of stock ownership, it also has less ability to determine prices on its own. Even if thousands of individual investors are enthusiastic about a microcap, they may collectively control less capital than a single mid-sized institutional fund. And institutions themselves are constrained. Many simply cannot buy stocks below a certain market cap, stocks below a certain price, companies trading too few shares each day, and businesses, which is a self-definitional problem, businesses with insufficient analyst coverage. This leaves a gap. The investors most interested in the company retail, often lack enough capital. Yep, often. They always lack enough capital to sustain a long-term revaluation. While the investors with enough capital, institutions, usually are, prohibited from participating. The feedback loop. This creates a cycle. The stock falls. Institutions become ineligible because of market cap or liquidity. Analyst coverage disappears. Daily volume declines. Financing becomes more expensive. Dilution increases. The stock falls further. At that point, the business may be improving while the stock remains trapped, because the investor base has deteriorated. This all sounds so wonderful. We'll get, maybe not today, but we'll get to how you can make money in this. But you got to define your enemy and his tactics before you can countermand them. Before you can countermand them. Yankees have acquired first baseman Luis Garcia Jr. from the Nationals. More to come. I guess we're not going for it. I guess the Nationals ain't going for it. All right. Let's keep going. Next question. All right. We already answered the shift to 15%. We used to invest on fundamentals. Now it's all algorithmic. So essentially the price doesn't tell you anything about the company. And that's actually true up in the high price stocks, which is what could cause, once private credit gets in trouble and panic sets in, that's what could cause a sell-off. Is retail the solution? Not entirely. Retail investors can and do discover companies before institutions, but a healthy market also needs independent research. A healthy market needs liquidity providers, long-term active managers, reasonable financing options, governance that protects existing shareholders. I argue this is all missing. One thing that has arguably been lost in the middle layer of the market, most of the market. Years ago, there were many regional brokerage firms. There were boutique investment banks and small cap mutual funds that specialized in companies worth 100 million to 1 billion. Industry consolidation, lower commissions, and the rise of passive investing have shrunk that ecosystem. So ChatGPT would frame it this way. The challenge isn't simply that retail is around 15% rather than a larger share. It's that the market price setting mechanism is increasingly driven by liquidity provision, indexing, and you see right here, quantitative strategies. While the institutions that once specialized in fundamental analysis of smaller companies have become fewer. They're gone. That doesn't mean fundamentals no longer matter. Over longer periods, they usually do. But it can mean that for smaller companies, the path from improving fundamentals to a higher stock price is slower and more uncertain than it was decades ago. Do the stock prices of these companies tell one anything about specific fundamentals, or do they just reflect the consequences of the HFT grim reaping machines? I don't know how this computer is going to understand my question since it has a typo. This one gets to one of the central debates in modern finance. ChatGPT's answer would be, in the short run, often not. In the long run, usually yes. But the long run can be much longer than investors expect. For many microcaps and small cap companies, the stock price on a given day is often a better measure of market liquidity and investor demand than the intrinsic value of the business. Consider what determines the price of a $150 million company on ending Tuesday afternoon. One fund needs to reduce risk. An ETF rebalances. Look, this isn't happening at the $150 million level. This is the problem. Anyway, a convertible holder hedges. A market maker manages inventory. There is no market maker inventory. Algorithms respond to order flow. Okay, HFTs and predatory algorithms, I'd go with that. Retail traders react to momentum. Yeah, if you're a day trader, and that's what everyone wants you to be, if you're hot money, maybe that applies. Luckily here, we are no longer hot money in general. I'm not saying once we have accounts that you can't do the odd day trade. None of these transactions necessarily reflects a new assessment of the company's products, patents, customers, or management. So the price, as I've been telling you, does not reflect fundamentals. That's why you'll sometimes see a company announce a positive development, such as a signing of a major customer or reporting strong quarterly results, and the stock finishes the day down. The market isn't necessarily saying, quote, this contract has no value, unquote. It may simply mean there were more shares available, and were they real shares for sale than there were buyers willing to absorb them at higher prices. That said, it's also important not to swing too far into your conspiracy theory. Sometimes a persistently weak stock price does contain information. That's true. If you know, that's why you got to know the story. That's why you got to know the story, because every picture tells a story, don't it? 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 All right. The market may simply mean there were more shares for sale, and they never get into the fact that the amount of shares for sale can balloon by all these tricks and exemptions. They never get into that fact. All right. It may simply mean there are more shares. Okay. Sometimes it can be weak because people are worried as a group, and that's true, of future dilution, the need to raise capital, sure, customer concentration, sure, cash burn, regulatory, competitive. The market is not always right, but it's not always wrong because of HFT. I agree with that. That's why you got to know the situ. Because Every picture tells a story, don't it? Every picture tells a story on it. All right. So what high frequency trading can and cannot do? It's often blamed for prolonged declines, but its primary role is usually to provide liquidity. Come on, come on. And profit from very short-term price discrepancies. That may be true up in the bigger stocks, but there's no defense in the lower price stocks against the crushing. Nobody sees it. Most HFT firms do not set out to hold a stock down for months or years. Well, I think that's true. Most of the day traders don't, but they swing trade it. But then you get groups like the Toad that do have that goal. Their positions are often measured in seconds or minutes. True, but it's a weapon of the toadsters. What HFT can do is amplify short-term moves. If buying pressure fades, algorithms may lower their bids quickly, making declines appear sharper. If selling pressure intensifies, they may widen spreads or step back from providing liquidity. That can make an already illiquid stock feel even more fragile. So why do you need HFT in illiquid stocks? Riddle me that. What HFT generally cannot do by itself is keep a fundamentally strong company permanently undervalued if there is sustained informed demand from long-term investors. I think that's true. And that's something we got to remember. If a company is fundamentally strong and there's sustained informed demand from long-term investors, but most people today aren't long-term, and that's what we're doing. We're becoming better investors. The missing ingredient. In many struggling small cap stocks, the bigger issue may not be HFT trading itself, but the absence, there you go, of committed buyers. I think all the HFT sellers should be committed somewhere. Imagine a company that is improving. Revenue is growing, margins are expanding, cash burn is shrinking, management executes well. If no institutions can buy it because it's below their size or their liquidity thresholds, and there are only a few retail buyers, then even modest selling can overwhelm demand. In that environment, the stock prices become a noisy signal. It tells you a great deal about who is trading and how much liquidity exists, but less about what the business may be worth over a multi-year horizon. I'm tired of compromising on the way to my horizon. All right, so some of you are dying to know. The Yankees acquired first baseman Luis Garcia Jr. from the Nationals. Washington will receive 4 players. Giovanni Cruz, a right-hander, and right-handers Jack Caber, Ben Grable, and Jack Bird are the other 3. So it's pitchers, pitchers, pitchers. Okay, Benjamin Graham once famously observed that in the short run, the market is like a voting machine, while in the long run, it is like a weighing machine. Even if that metaphor still broadly holds, I'm not sure it does, Today's voting machine includes quantitative strategies. These predators, passive funds, and an electronic market maker alongside traditional investors. That can make the connection between business performance and stock price feel weaker over months or even years, especially for smaller companies. I would be cautious, ChatGPT would, about concluding either that the price fully reflects fundamentals or that it is merely a product of a grim reaping machine. Well, I think each of us has to have our own assessment because we've done our due diligence. For many microcaps, the price often reflects a combination of business fundamentals, financing expectations, liquidity conditions, and the current mix of market participants. Untangling those influences is difficult, but the balance can shift over time. What attracts sustained institutional buying? Institutions need confidence that several things have changed. The company has enough liquidity for the company to build an event, for the institution to build a position and eventually be able to exit that position. So the company has to have enough liquidity in the share volume. Financing risk has declined. Revenue growth is durable rather than a one-off. Management has established credibility by meeting guidance or executing consistently. The addressable market, we've talked about that, is large enough to support future growth. Valuation is compelling relative to all of the above. For biotech companies, a major regulatory approval can be transformative, but institutions still want to see commercial execution. For industrial or technology companies, a single contract is often less important than evidence that it leads to, or that it will lead to, repeatable revenue and improved cash flow. One contract ain't cutting it, but evidence that that contract is going to lead to repeatable revenue and improving cash flow can. It can do it. It can do it. It can do it. Come on and do it. Do it till you're satisfied. All right, so let's go. I think I got lost again. But if I did, no, I'm going to correct myself before I put you through it. I'm going to say, this is where I need to be. This is where I need to be. And that way I won't waste your time. Can't wait till I get my electricity back. I don't know what it is. I think it's something downstairs. All right. Let's see if I found it. Does institutional buying end the quicksand? Often, yes. but not simply because institutions are buying. It's which institutions are buying, it's why they're buying, and it's whether they keep buying. Think of a microcap stock as a small pond. If one shareholder wants to sell 500,000 shares, the price can fall dramatically because there aren't enough natural buyers. Well, okay, let's think of it as a small pond that some sewerage company keeps bringing loads of sewerage in and disposing illegally. That could drop the price of the pond too. They assume such fair dealing. It doesn't exist. Anyway, now imagine a long only mutual fund decides the company belongs in its portfolio. This is on the other hand, and wants to buy 5 million shares over 6 months. That creates a persistent source of demand that can absorb selling. The market becomes deeper, it becomes more liquid in dollar numbers, and the price may become less sensitive to individual trades or to HFT predation. That's why sustained institutional ownership can sometimes change a stock's behavior. However, not all institutional buying is the same. I know. If the toad is buying, beware. Long-only mutual funds, pension funds, and some asset managers may hold positions for years. That's stable when they buy, and it provides a more stable shareholder base. Hedge funds may be trading around catalysts or arbitrage opportunities and can sell just as quickly. Yeah, we see that all the time. Quantitative funds, if you want to give them a nice name, may be buying the stock because it fits a model and sell automatically when it no longer does. That's your hot money, your day trading, it's all the manipulation. ETF ownership, they're not down here. It may increase demand if money flows into the ETF, but it can work the other way when investors redeem shares. The type of institution matters as much as the fact that it's an institution. What attracts sustained institutional buying? Institutions need confidence that several things have changed. The company has enough liquidity for them to build an eventual exit position. I feel like we already talked about all this. So let's go through it quickly. They want to see financing risk decline. Revenue growth is sustainable. Management has credibility. The addressable market is large. And all of this may bring buying, particularly repeatable revenue and cash flow. So I guess I did get a little bit lost. Can institutions arrive too late? Retail investors often feel institutions don't buy until much of the upside has already occurred. And that's true. It's by mandate. It's also, they'd rather pay more and have more certainty of outcome. There is some truth to that. Many institutions are constrained by investment policies that prevent them from owning small, illiquid, or low-priced stocks. They may wait until the company has crossed thresholds for market capitalization, trading volume, or business maturity. This can create a frustrating dynamic. The stock may need institutional interest to re-rate, but institutions may wait until the company is already on firmer footing. Does it end the quicksand? It can, but it's not a guarantee. A company can have increased institutional ownership and still decline in price if earnings disappoint, dilution continues, the industry weakens, or the institutions have decided to exit. Okay. Conversely, companies that achieve sustained profitability, improve their balance sheets, and reduce dependence on external financing often become more attractive to long-term investors. When that happens, the shareholder base can shift from primarily short-term traders to longer-term owners, and price action may become less dominated by day-to-day liquidity dynamics. So, institutional buying is often a symptom of a company's transition to a stronger footing as much as it is the cause of a company's higher stock price. The business improvements usually come first, and durable institutional demand tends to follow when investors conclude those improvements are likely to persist. What might trigger institutional buying? And look here from ChatGPT, from the Chatmeister. This is probably the single most important question for anyone investing in microcaps. Institutions generally, sorry, I ran out of water. Let me have some coffee. Institutions don't buy because the stock is cheap. They buy because they believe the risk profile of the company has fundamentally changed. Here are the most common catalysts. One, the financing overhang disappears. This is one of the biggest. Many institutions avoid companies they believe will have to issue stock repeatedly to survive. And that's really logical. So it's self-defining. If a group like Lynn Partners can get a CEO signing a deal that locks them into issuing shares, it's hard to raise institutional money. The way I describe it is that if an institutional cannot define what the denominator, the number of shares is or could be, they're not going to buy. So if a company becomes cash flow positive, raises enough capital to fund operations for several years, pays off expensive debt, or secures non-dilutive financing, that's a key, secures non-dilutive financing, the investment case can change overnight. And this would be an interesting thing to test. For example, in the case of Nextrip, if the changes in the document, or if the company actually can do what it says it wants to do and pay back the debt before a single share is issued. That essentially makes the financing non-dilutive, and then the investment can change overnight. But let's press back on that. Let's study it. Many portfolio managers would rather buy at $8. And hear this exactly. They'd rather pay $8 after financing risk is gone than at $2 while dilution risk remains a concern. And that applies at Railtown too. You guys don't believe me, but ironically, as Railtown crosses thresholds, demand may actually go up. An $8 Railtown may go to $15 quicker than all the boo birds can make fun of me. So, number two, revenue becomes predictable. A single contract rarely changes an institutional position. Remember that. One piece of news isn't going to do it. 5 consecutive quarters of revenue growth often does. That's true. Or if you get several pieces of information, so internally an analyst can look at, okay, here's the total market, this is the trend, they're claiming this space, and a lot of that quarterly work can have already happened over the previous 6, 7, or 8 quarters. So don't just automatically assume that when you get in a new situation that you've got to wait a year and a half. Doesn't make sense. And it's a highly competitive business, and institutions jump the gun when they know something. Institutions want confidence they can model the business. Bingo. They want to be able to model the business. There you go. And put it in your file, get a vote, cover your ever expanding rumpus, and not have career risk. Recurring revenue is especially attractive because it makes future performance easier to forecast. So recurring revenue can be predicted if it can be predicted with confidence. 3, profitability. Nothing changes perception like profits, or if you're hot. A company that demonstrates positive EBITDA, though this measure has limitations, operating profitability, or positive free cash flow. If a company has these kind of things, it often enters a different category for investors. I don't like EBITDA that much. I like cash flow better, but positive EBITDA, profitability, or free cash flow. For regulatory certainty, for biotech and medical device companies, a major regulatory milestone can be pivotal. Before approval, the stock may be viewed as highly speculative. After approval, the question becomes, how much can it sell of the product? It moves away from, when will I be loved? When will the product be approved? To, how much can it sell? That doesn't guarantee success, but it removes a major source of uncertainty. 5, market capitalization and liquidity. Many funds literally cannot buy companies below certain thresholds. Those thresholds vary by institution, but can include minimums, minimum market cap, minimum daily trading volume, minimum public float, minimum share price. Once a company exceeds those limits, that company becomes eligible for a much larger universe of potential investors. Index inclusion, that's not going to happen down here so much. But if you get included in the, I don't know, the Toronto Exchange Index Fund by E.F. Hutton, it's mandatory buying. I don't think we have to focus on one, but it's important. It goes both ways, of course. And it's non-thinking. You just have to be bought. Analyst coverage. When a respected research firm initiates coverage, more institutional investors become aware of the company. Coverage alone isn't enough, but it does reduce the unknown company problem. 8, management credibility. Institutions notice consistency. If management repeatedly meets guidance, avoids unnecessary, does what it says it's going to do, avoids unnecessary dilutions, allocates capital well, and communicates clearly, sometimes with the help of other people, investors often assign greater credibility to future projections. One final point: institutions are not a monolith. A deep value fund, a growth fund, a biotech specialist, a quantitative fund may all evaluate the same company differently. Often the first institutional buyers are small specialist funds with expertise in the sector. If the company continues to execute, larger generalist funds may follow, creating broader and more sustained demand. Where do CEOs' duties lie? With the corporation, the shareholder, or vaguely with both? This is a deceptively simple question, and the answer is one of the most misunderstood areas of corporate law. And I'm not a lawyer, by the way. The short answer is, you could have guessed this, a CEO's legal duties are owed to the corporation, acting through its board of directors, not directly to any individual shareholder. That has important consequences. The legal framework in most U.S. corporations, particularly in those incorporated in Delaware, directors and officers owe fiduciary duties principally to the corporation, and then, by extension, to all of its shareholders collectively. The two classic fiduciary duties are duty of care, making informed, reasonably careful decisions; duty of loyalty, acting in the corporation's interests rather than for personal gain. A CEO cannot legally favor one shareholder over another simply because that shareholder is vocal or owns a significant stake, unless specific legal rights apply. What doesn't always trigger institutional buying? A little out of sequence. Many retail investors expect these events to transform a stock, but these events by themselves often don't. One press release, one customer announcement, one patent, one conference presentation, one optimistic interview, one promotional campaign. Institutions usually ask, how does this change the company's future cash flows or risk profile? If the answer is not much, they may wait for more evidence. What creates a real re-rating? The most powerful catalyst is often not a single event, but a series of developments that may together change how investors classify a company. For example, a company was burning cash and issuing stock every year, and now it launches a successful product, revenue doubles, gross margins improve, cash flow turns positive. It no longer needs frequent equity raises. Trading and volume increases. More institutions can own it. Analyst coverage expands. At that point, the market may begin valuing it differently because investors see a more durable business rather than a speculative one. I'd really rather see a more durable business than a speculative one. I'd really rather I really rather. Of course, I'm somewhat lost again, but I think we're moving on to the last question. And do you know that the Nationals had the best offensive team in baseball, arguably, with Garcia, James Wood, C.J. Abrams, and Curtis Mead? But the Nationals have traded Curtis Mead and Garcia. I guess they don't want to win this year. Okay, here we go. Why hasn't this obvious realm of fleecing the retail markets been brought to a halt? No one cares? Or is the gravy train to attorneys, the bird dog financing firms, hedge funds, and ultimately to regulators in Congress, the revolving doors and donations, just too gigantic to ignore? That's a question that gets into economics, politics, and incentives as much as securities law. I don't think the evidence that's ChatGPT supports the conclusion that there is a coordinated effort to fleece retail involving regulators, Congress, attorneys, hedge funds, and market participants acting together. You wouldn't. That would require proof of a broad conspiracy that hasn't been established. Of course not. However, there are structural incentives that can produce outcomes many retail investors view as unfair, even without anyone coordinating them. Okay, let's go about it. Here's how I would think about it. Markets optimize for liquidity, not necessarily for fairness to every participant. Over the last 30 years, US markets have been redesigned. Do you see it? Redesigned around goals such as lower trading costs, tighter bid-ask spreads, faster execution, higher volumes. I would wonder if those were the goals or the stated goals, but the real goals were what is happening in the shadows. But let's not be picky. So by these measures, lower trading costs, tighter bid-ask spreads, faster execution, higher volumes, the markets have been remarkably successful. The average investor can now buy 100 shares of a large company almost instantly. Well, why do we need that? For essentially zero commission. Why do we need that? But those same reforms don't necessarily work as well in the 100 million microcap area with limited trading volume. In other words, the market structure was largely built around efficiency, not around ensuring that every small public company has robust price discovery. You can say that again. I won't, but you could, if you wanted to, say that again. Every participant responds to its own incentives. Consider the ecosystem. Law firms are paid to structure financings that comply with the law. Investment banks are paid to raise capital. Hedge funds seek attractive risk-adjusted returns, especially if you remove all the risk by cheating. Market makers earn money by providing liquidity, I guess. Exchanges benefit from listings and trading activity. Regulators have finite budgets and must prioritize enforcement. Okay. None of those incentives necessarily align with maximizing returns for existing retail shareholders. None of them do align with that, I think you could say. That doesn't imply misconduct, but it can create outcomes that retail investors find frustrating. No kidding. Retails lose their money and everybody else dines at Mel Croupen's. The SEC has to make choices. The SEC oversees thousands of public companies, broker-dealers, advisors, exchanges, and trading venues. It cannot investigate every questionable financing or every sharp decline in a microcap stock. As a result, it tends to prioritize cases involving clear fraud, insider trading, accounting misstatements, market manipulation, supported by evidence, large investor harm. That leaves many practices that are controversial, but legal. So in other words, they don't check out retail over the counter. It's too small. The revolving door is real, but its implications are debated, of course. As long as you're debating, you don't have to reform it. It is true that people move between the SEC, private law firms, exchanges, financial institutions, compliance consulting. Critics argue that this it does create incentives for regulators to become too accommodating. Supporters argue that securities regulation requires specialized expertise and that movement between the public and private sectors helps develop that expertise. I think it helps develop the ability to cheat. Both perspectives have advocates, and reasonable people disagree about where the balance should be. And as long as we're arguing, we don't change anything. Let me ask you this. Why don't microcap stock prices go up sustainably for a while? Like, for example, one could argue happened with SpaceX, so that microcap companies can use their stock price to go buy a company. Ain't gonna happen. All right. Why don't lawmakers simply ban toxic financings? One reason is there are trade-offs. And just get ready to vomit here. If the regulators prohibited many high-risk financing structures, some distressed companies might lose access to capital altogether. Why not? Why not? If you can't meet certain attractiveness, why continue the pain? I said okay. Anyway, that could mean more bankruptcies and fewer opportunities for struggling businesses to survive. Okay, fine with me. By signing these things, you're just turned into a treadmill. The counter argument is some financing terms are so dilutive that they transfer excessive value from existing shareholders to new investors. They don't go to new investors. It goes to the predators. Look how rich a really untalented guy, in my judgment, Jeff Easton, has become. You're just transferring hard work and results, in many cases, to an FF who was shown how to do it. Critics contend that stricter limits could provide fairness without cutting off all financing. Where to draw the line is a policy question, and there isn't universal agreement. Thanks. I think you should hold CEOs accountable because the SEC people are not trained to go after the shorting or the manipulators. Go after the CEOs. I mean, if how can, but the law doesn't prevent it. How can a CEO actually sit down and see, like in the case of Finger Motion, what is going to happen to his stock price? And there's no way for a big happening to come in. I mean, I guess you should never say never. How can you sign it? But the law says if you disclose, if you think that gives you a chance, it's a good decision. I don't know, guys. These markets and the regulators, it's built up over time, and there's no fix. There's no fix other than making sure we choose companies that have CEOs committed to doing rather the right thing on behalf of shareholders, rather than making decisions that should see them committed somewhere. Comes down to really understanding a company. Why do retail investors often feel powerless? This is one of the strongest observations you've made. Retail investors are fragmented. A hedge fund may own 10% of a company. An activist investor may have a board seat. A lender may negotiate directly with management and essentially have management's family jewels in its grip. Retail ownership, by contrast, is often dispersed among thousands of individuals who rarely coordinate. While shareholders can vote, submit proposals, or organize, doing so effectively requires time, information, and resources, and attorneys. And you just can't compete. My broader observation, ChatGPT, I don't think the primary problem is no one cares. That's what I always say. Rather, different participants care about different things. And this is fair. When you're dealing with the market, and the reason you have to read it with cold eyes is it is a competition. And there's competitors out there that want nothing other than to win. They don't care about extraneous issues. So it's key to look at what motivates different participants. Regulators care about enforcing the law within their resources. What a non-statement. Exchanges care about attracting listings and trading. Well, okay. Institutional investors care about returns. True. Market makers care about liquidity. I don't even think there's real market makers anymore, and I don't think liquidity is what's on their mind. Companies care about survival and growth. Yep. But why would they step, in a pool of quicksand? Retail investors often care about long-term value and fair treatment. That's what it should be. These objectives overlap in some areas and conflict in others. Where many critics, including academics, former regulators, and market practitioners, have expressed concern is that the economics of the current system may underserve the smallest public companies. May? Can you just say does? The economics of the current system underserves the smallest public companies. Reduced analyst coverage. None. No analyst coverage. The dominance of passive investing. Fewer small cap specialists, maybe none, and the cost of being public have all changed the environment. Whether the solution is more regulation, different market structure, stronger governance, or new financing models remains an active debate, so you don't need to do anything. I think different market structure. Take the over-the-counter and the NASDAQ away from Chuck E. Cheese and Adina Friedman, put it in a not-for-profit government supervised cabinet position, make it a career, and make it physical trading. So I would distinguish between structural incentives and intentional collusion. There is substantial evidence that incentives can produce outcomes that create disadvantages for some retail investors. Why? Why the careful wording? There is much less evidence for the broader claim that these outcomes result from a coordinated effort among regulators, lawmakers, and market participants. I don't know. You can make your weasel words. I'll stick with what I see. Well, who has the advantage? Retail or the relentless HFT algorithms, the program sellers? If the question is who has the advantage in short-term trading, the answer is fairly clear. High-frequency trading firms and other sophisticated electronic market participants generally have advantages over individual retail traders. Those advantages include extremely low latency. They can react in microseconds or milliseconds. They can co-locate servers near exchange infrastructure. They have sophisticated statistical models. They have large engineering and quantitative research teams. They have access to extensive market data. They have the ability to trade thousands of securities simultaneously. Retail investors generally, retail investors cannot compete on those dimensions generally. Face it, retail can't do that. However, that doesn't mean HFT firms have an advantage in every aspect of investing. Well, let's see. Where retail is at a disadvantage. Retail investors are generally, are at a disadvantage when trying to day trade against professional firms. Retail is at a disadvantage when trying to predict short-term price movements, when trying to profit from tiny pricing discrepancies, when trying to provide liquidity in fast-moving markets. Those are areas where HFT firms specialize. Where retail may have advantages. An individual investor can sometimes have advantages that many professional trading firms do not. Retail investors can adopt a long investment horizon without need to report quarterly performance. That's a big deal. Retail can have the flexibility to ignore short-term volatility if they can just train themselves to do so. That's a big deal. Retail does have the ability to invest in companies which are too small for many institutions. True enough, that's an ability. We have to know the risks, but if we've done our work and see the real value, that's an advantage we have. Many funds can't do it. And then we, as retail, have freedom from portfolio mandates, which restrict which shares can be owned. So if we take these advantages seriously and we don't piss them away, These are true advantages, and they give us the potential for powerful returns. These advantages matter most when the investment thesis depends on multi-year business performance rather than short-term price movements. We don't have advantages in day trading and swing trading. Now, if you have a source that you feel is being fair, get in early, get out early. Do algorithms program sell? Some algorithms are designed to sell under certain conditions. For example, when prices fall, volatility rises, or portfolio exposures change. Others are designed to buy under those same conditions. Many market making algorithms are buying and selling continuously to manage inventory rather than expressing a directional view. I think, come on. If a stock is under sustained selling pressure from multiple sources, fund redemptions, see, they don't understand. Small stocks don't have fund redemptions. Hedging activity, highly unlikely unless the toad is using it against one of Lynn's financing or financing related sales. Now, that may be happening. Algorithms may reinforce the move by adjusting their quote. That's what they do. They walk the bid-ask box down. To an outside observer, this can look like relentless mechanical selling, and it does. It does look like that. But they're bullies. They change. Once they're punched on the nose, it all changes. Key distinction, one point worth emphasizing is high frequency trading firms are usually not trying to decide what the company is worth. Exactly. That's one thing I want to get across to you over and over again. When they do these things, and it is algorithmic, by the way, and they are trading thousands at a time, they are not basing it on what the news says or what the company is worth. And that's an advantage that you have. If we can calculate what something's worth, it doesn't remove all risk. But it does give us an advantage. Their business and HFT's business is often to facilitate trading and manage short-term risk while earning small margins on enormous volumes. If a microcap stock declines for months, the underlying cause could be broader than an HFT alone. Yeah, but there's never any respite. It could be repeated share issuance, sure enough. It could be weak demand from long-term investors. Yes, and that's often self-defining. It could be sector-wide risk aversion. Yes, Chinese stocks, for example. It could be liquidity constraints. Yes, so why is there high-frequency trading at all in illiquid stocks? Or deteriorating business fundamentals? HFT trading can amplify the day-to-day price action, but it's not necessarily the root cause of a prolonged decline. Why it feels different in microcaps. Many small cap investors have a legitimate concern that there are relatively few, none, natural long-term buyers for small cap companies. When persistent sellers meet limited long-term demand, the stock price can become heavily influenced by short-term liquidity dynamics. In that environment, algorithmic trading can seem to dominate because there isn't enough sustained fundamental buying to offset routine selling. So, if the comparison is retail trader versus HFT in a battle over intraday price movements, the professional firms generally have substantial structural advantage. If the comparison, and look here, if the comparison is patient, long-term investor versus short-term algorithm, and by the way, long-term doesn't have to be, long-term used to be 5-10 years. Long-term could be 6 months, 9 months, a year, year and a half. It's different. A successful long-term investment doesn't require beating an HFT firm at its own game. It depends on whether the company's underlying business ultimately improves enough to attract durable demand from long-term investors, institutions. The challenge for many microcaps is that that process can take years, and some companies never reach that point. Well, you can invest in a company as it meets that multiple year standard. Some people get in just before the inflection point or during it. All right, let me go to some of your comments. Ricky Brogan on Railtown. I'm thinking it after 8 months since the MOU was completed, we should see one revenues this quarter. The MOU is a memorandum of understanding. They skipped kind of ever announcing the letter of intent as a separate announcement. They rolled up the letter of intent and the conclusion all in, you'd have to look it up, in a November 27th of last year acquisition of AIP Partners. That, since then, that wasn't an MOU. That was the actual purchase of AIP Partners. And do they owe us something in 8 months? I don't think there's any significance to 8 months at all. I think the more important thing probably as it relates to Railtown is those network of companies, 200 of them, who collectively do over 500 million in revenue and spend something like 200 million on hyperscalers and are all in the business of providing AI as a service to their end users. They're all mostly Canadian. They are eligible for Canadian government and provincial funding. And the Canadian government has put a lot of programs in place to fund these companies, and maybe even the roll-up strategy that Railtown AIP Partners has. The key thing to remember is that Dr. Tom Core made his bones in this space. He probably is the preeminent Canadian funder of technology companies, from think tanks, from pools of money that are maybe not governmental, but they're also not private, from private funders, from the government. This is what he does. And in that November 26th agreement, they included a company called Digital. Digital is critical in order to be the applicant for this government funding. The government funding had a cutoff application day of June 1. I think that's important. How long does it take a Canadian bureaucrat to get through her files? Sounds like a joke. but it's probably how many Canadian bureaucrats? 15. So they can have a rotating committee meeting of 5 every week for 90 days and then stretch it out to 9 months. I don't know how long it takes them to go through something. But once they process those applications, and if the digital and the Tom Core help leads to financing, then you'll, from the government, then you're going to start seeing news. During that period, remember there was a November meeting of representatives, 28 of them, I think, around the country discussing the AI for all prerogatives and presentation, voted into place in December or January. From that time, there's been a quiet period. I don't think 8 months has anything to do with it. I think what's really important, if you want to participate in that government financing, and it's more than just the financing, it's government business, it's defense business, it's bank business, it's healthcare business. If you want to be in that trough, you got to keep your mouth shut. And I think that's more important. Ricky Brogan, hopefully we'll get some revenues, and that will allow institutions in Canada to start buying shares. Again, I think it's two different things. I do think there'll be revenues. Railtown used to not be, but this year it converted to a calendar year in finances and reporting. I think for their second quarter reporting this year, which should be in the last week of August, maybe sooner, but it should be the last week in August at the latest, I think you're going to see some revenues for the second quarter. I don't think that's going to be enough to trigger institutional buying. I think any of those revenues will be moderate. And really, unless you understand the business and unless it fires you up as an institution, it's not going to cause institutional buying. But the company can go from pre-revenue to revenue along with its announcement, July 8th, you can look it up, that they no longer are I'm using my own words, that they're no longer an R&D firm and they're now going in the commercialization of their product, which is now the broad platform. They have decided to address essentially 98% of the Canadian enterprise market. That's a lot. It's wide open. And they've aligned with a major international firm. I think it's WSR. You can look it up. The initials I might, because Ward just used a different one, so it's tricking my memory. But anyway, this is a major firm, deep client depth, deep Rolodex. They announced it in July. Typical turnaround is 90 days or less. So I think you're going to start seeing information come out on that in the September, October, November, December timeframe. Those are information and numbers that can be put into institutional models. And it won't show revenue right away, but it could attract institutional buying, particularly if Railtown's definition moves from being an SaaS developer tool helping developers help developers develop, which is totally meaningless, to this is an ADK AI agentic platform, rail engine, rail tracks, and conductor that is critical as the interface. I don't know what they would write in the orchestration layer or in the inference layer. Whatever Wall Street needs to see, that would change right overnight. So you change to a revenue producing company, and to that, it's going to get on a lot of institutional screens. But I don't think revenues are going to allow institutional in Canada to start buying, not from the second quarter. I think that's those two things matter, but that's not what's going to make it happen. I think what will make buying happen of Railtown in August is if institutions in New York City, for example, notice that the Texas-based Hive Buzz company, digital company, is involved in Canada with a subsidiary. And hey, look, I'm making it up, I don't know. But maybe one of their portfolio companies, Brookfield, who they have investments with, is backing the development of data centers. That's what Brookfield does. And Carney came from Brookfield. I'm making a very elaborate web here that I can't back up. But if something like that hit an institutional desk in New York City, Ricky, you're not going to see it. It's not going to be announced. But that New York City institution who is competing to be better at AI than all of the competitors, it might be a small fund trying to compete with bigger funds. Their goal is to be first. They're going to study it. They're going to model it. And they're going to call the different players, and they're going to listen, and they're going to tell their commitment committee, we better buy 10,000 shares of this. Now, that can happen without news. That can happen without revenues. All it needs is somebody seeing what's under the hood at, and I'm making this up, but maybe a Brookfield, maybe a BSC, maybe a Hive Digital. Why do I pick on that? Because the developer of business at Railtown has reposted and liked stories on those three, primarily the first two and primarily the Buzz Hive, I'd say 60 times. So it's a logical conclusion. Another thing is the Zaid Atufat Shamsi joining the board at Railtown, the advisory board. He's the guy at TELUS who has built the NVIDIA stack at the first sovereign AI factory in Canada. Of course, their committees take forever. They've largely squandered their lead, but a different explanation may be that Kamloops is ready to go, and maybe the expansion at Rimouski, and maybe they're waiting on delivery of the Vera Nice Rubin chips. That could be it, where you get 5 or 8x running capacity and therefore revenue capacity for the agentic AI era. That could be what's going on. Those changes happen, Ricky. And if someone in that loop, they're going to recognize, they're going to ask, who's covering the orchestration layer? Who's covering the governance layer? Who's governing the conductor, the tracks of this? And if Railtown has a meaningful role there, that institution can start studying it and doing their due diligence without a public announcement, without revenue. And I would argue, Ricky, it's more important than an announcement or if retail starts buying. Retail buying does not scare the HFT sellers. The only thing that's going to scare them is if preferably two institutions Maybe a New York institution stays behind from the Hampton vacation because they want to build a position before all the AI money gets redirected to the orchestration layer. And it's more than just that. In September and October, they want to get a head start before every money goes there. And Railtown's one, if not the only public stock you can buy. They stayed behind in New York and they're buying a position, but maybe up in wherever, Toronto or in I don't know where, Vancouver, or maybe somewhere around there. The smaller firms, maybe somebody stays back. The guy that doesn't have a date, is not married, and isn't invited on vacation, maybe he stays back. And he's working, and he's a small fund. And in Canada, there are small funds. And in Canada, there is research down in the smaller area. And maybe he or she sees information about the Buzz Hive, the Mark Carney, the AI for All, the Ontario for Excellence, the digital, and they're picking something up. They make some phone calls. And you know Railtown's working, they could start buying. And they don't need news. They don't need revenue. They got their own brains. They got their own model. They're not pussies. They jump in once they've covered it. And so then you got two bidders. And you could have that happen in August, and there isn't a single announcement about it. Alternatively, you could have announcements that say, I mean, if you want to dream, you could have an announcement from, let's say, TELUS finally realizes that they've given up their head start, and they make an announcement that we are installing Vera Rubin at Kamloops and this other one, Rimouski, and our schedule is September, October. And by the way, in order to make this investment work, let's dream that they actually say it. We are using Cohere. I don't know if they would, but that's Canadian. And we're using Railtown AI Technologies. That's Canadian. I mean, best of all worlds, they would announcement. Well, then you're going to have institutions around the world racing to find out who the hell is Railtown. My guess that more likely is Railtown is always going to be under the hood. Analysts are going to have to dig deep, but they will. They will, and it will break. But Ricky, we don't need some revenues to allow institutions to buy. That's not what you're in. If we get some revenue announcement, there might be a spike as some of you or me, I don't have any money, run it up. And then the guys that work with the total drive it back down for short-term profit. But I mean, I like your enthusiasm, but it's just not what's going to make it go. What's going to make Railtown go, preferably, is 2 institutional orders. And then it depends on what value, because remember, like you've done, Ricky, like we've done here, we've started top down. We've come up with the addressable market. What part of the market can Railtown get? Is there a defensible moat? Does Railtown actually have something? What is the makeup of their board? How much of that addressable market can we model that Railtown might get? What is their margin? We've done all that work. Is their share base capped? And we're pretty impressed that it is. Do they have toxic financing? Do they need money? Are they now in revenue? We've done all that work. We've come up with our targets. I'll tell you mine. I think the stock's a $55 stock by the end of next year to 2 years. Could happen much more quickly. But my more reasonable target is 100x from here. As soon as awareness comes, as soon as the modeling comes. Now, when would that be reasonable? I mean, it could happen very quickly, but to be reasonable, maybe in the first quarter or second quarter of next year. But I think you've got 10 or 20 or even 30x just in a re-rating. That's because we've done the work from on top. Well, institutions are going to do that, Ricky. They have their own models. They have their own assumptions. They know NVIDIA. They know Cohere. They know FireEye. They know Buzz Digital. They have sources of information they pay for. They have committee meetings. They have investor committee meetings. They have trained analysts. They can pick up the phone and call other analysts. They can call the company. And if they don't have an NDA signed, they have a picture of what the stock is worth. And I'm not saying this is what they publish. I don't know a single analyst would ever publish these targets. But let's say one of those analysts thinks that Railtown can be worth $25 by March next year. And the other analyst thinks that Railtown can be worth $12 to $15 by March next year. They're not publishing that. They're telling it to their investment committee. And they think that Railtown, in fact, could be one of the survivors over 5 to 10 years that claims it's part of a multi-trillion-dollar a year industry over the long run, and that we're going to hold this stock as a foundational holding for the next 10 or 20 years. Well, then the question is, what's the size of the order they put in? Let's say there's an institution in New York that says, we want to own 4.99% of this company before everybody gets back to school. And there's a small fund up in Canada that says, I want to own everybody 4.9, well, let's say 2.5% of the company before everyone gets back from Banff or from Florida or from some dacha in the woods. Well, then you've got two orders. They're not limited like we are. Well, the stock is 23 cents, and if it goes to 40 cents, I better take some money off the table because, you don't go broke taking a price. That's not how they see it. They trust their models. And if they see that they can make 10, 20, 30x in the next 6 months to 9 months, and they're going to hold it long term, they may put in an order to their team, and they're sensible about it. But the small company might say, buy 5 million shares up to $10 Canadian. And do it in stages, but we're willing to buy up to $10 Canadian. And do it before everyone comes back to school. And the person in New York might be saying to their computers or to a person, an intermediary, I'd like to buy 20 million shares, or no, let's say it's only 4.99. I'd like to buy 10 million shares because her projection might be $25. I'd like to pay up to $15. Remember, they'll be averaged in. They'll get a net lower price. I'll buy 10 million shares up to $15. You have those two buyers in there who are not basing it on the stock price or what's being said on Discord or what the charts are showing it. They're basing it on their analysis of what this company and what this industry could be worth and could be worth to a buyer, and they want to own it. That's what you're waiting for, Ricky. Not hopefully we'll get some revenues and that'll allow institutions in Canada to buy. That's not what you're waiting for. But don't despair. I think there is buying going on now in Railtown, but I might be misreading it. I don't have the sophisticated order flow, but to me, Railtown acts as if there's at least one buyer in there that is inelastic to the price of the stock right now. In other words, they're not trying to get a lower price. If the stock price starts going up, they're going to keep buying it. I think there's a bid, maybe more than one, underneath Railtown, and I think it's tight. And I think you're watching in real time the change in the high frequency trading algorithms. That's my opinion, and it could happen in August without an announcement at all. Announcements would help. There's no question. You're right about that. Harbison, not sure if this new, but they have pricing listed on the conductor webpage. Well, I saw that, and my takeaway from the pricing on the conductor webpage is Railtown has 4 or 5 sources of revenue. And yes, going after enterprise by enterprise by enterprise, it's going to be that hookup model. But also, if conductor becomes the buffer, let's call it conductor cloud, between Thales and maybe BCE or maybe Rogers and the data centers behind it, I don't think it's going to be very hard for a user to sign up and say, you know what, I'm in Canada. I want to qualify for some advantages maybe that the government's giving for keeping AI in Canada. But I want redundancy. I want cost advantages. I want security and safety. And I generally just want to trust my hyperscaler. So I'd like to segregate my business into those 4 or 5 areas that have to be secure, like health and finance. But the rest, I don't mind if it goes to Microsoft or to AWS. But I'm gonna hire Conductor to do that. It's not hard to do. You just click you click your data center preferences, and then you click Conductor, just like we do when we're trying to buy sign up for a service. So my point is adoption of the Conductor platform is going to be easy. I think it's going to be instantaneous, and revenues are going to start showing up right away. But I don't know, Harbison, if I showed it. I thought I showed it. I'll look at it again. Unknown Stuntsman at work. My coworker wants to know, what do you think about the yen? What is he yenning for? If his yen is for love, a little risky. If his yen is for a warm gingerbread man cookie, you can probably get that yen fulfilled. What I think about the yen and Japan in general, I think it's more complicated than what is in the news headlines. But I don't think the carry trade is as free of risk as it used to be. Number one. Number two, I think the earthquakes going on in Japan are massively expensive. So there might be a reason that Japan is selling U.S. bonds outside of any theory. Thirdly, Japan gets the majority of its oil from the Persian Gulf. Trump chose Netanyahu over Japan. I guess that was a good choice. Israel is such a great ally. They buy so many of our goods and so many of our bonds that we obviously have to go with that maniacal man. But I think Trump chose Israel, and one of the costs to the United States, the dollar is no longer going to be the world's premier currency. We will no longer be the reserve system. We're going to be kicked out of the Middle East. Oil will be priced in many currencies. Maybe one currency will achieve seigniorage. Maybe it'll be China. I doubt it. Maybe it'll be Russia. Russia's got a pretty tough reputation now, but it's hard to believe. Maybe the United States will be at the table in a reduced role, and maybe it will be the World Bank's currency, which I'm having a hard time remembering what it's called. The special drawing rights, I think it is, at the World Bank. I think that is it. Maybe that becomes the currency, and maybe that gives the World Bank or the International Monetary Fund the ability to get rich. I don't know. I think it's too associated with the United States. We have blown our relationship with most of the world. So I don't know what replaces the dollar. So maybe it won't be a free fall, but it's going to happen. I don't think it's going to be XRP or any of that. I have this feeling it could be tokens, AI tokens. Anyway, so in that environment, I think Japan is selling U.S. securities. They need to buy oil. It's gotten expensive. They may feel like they have to increase their defense. And Trump has made it clear to the world that the United States sides with Netanyahu. I don't know how this puny man has so much power, but it's clear. So maybe Japan's selling for one or any of those reasons. But I think the biggest thing to think about with the yen, and I'll try to have a better answer next time I come on tomorrow, but I'm just giving you my thoughts without researching it. The thing to bear in mind about the yen and about Japan in general is that the Western banking system runs its experiments in Japan. And so, I mean, I don't think it's good news that they're selling U.S. securities. And I can't think of what that experiment would be. But I guess your friend wants to know, is the yen going to be strong or weak? I think all of us have to stop looking at fiat currency as strong or weak. That's not where our wealth is going to be. Unfortunately, all of us still think about dollars as our wealth or the yen. And of course, that's how things are transacted. But you'd be surprised in the background how quickly, I think tokens are now run on the the dollar stable coin, you can be surprised how quickly it can change. But I think the number one thing isn't the yen versus the dollar, and it isn't the dollar versus the yuan, or the dollar versus the loonie or the ruble. I think it's the dollar, the yen, the yuan. I don't know so much about the ruble, the euro, the loonie, the peso, against gold and against oil. And I think at some point you're going to see there's a lot of uncertainty out there. AI is taking a lot of capital. But if AI goes into a period, and again, I think I've shown you, and I'm comfortable with AI per se doing poorly, does not mean that Railtown's going to do poorly. The fewer data centers built, the more concern about data center leases. It's going to increase the focus on whatever they call the orchestration layer and however they break it out. It's going to make it more valuable. But anyway, for all those hundreds of billions and even trillions of dollars that are currently going into AI, if that slows down, and if we go to war, which it looks like we are, although he always seems to start and stop it, those monies are going to go to energy and to miners and maybe parts of the AI. But I don't see any situation where the dollar is going to be stronger than the yen. I think in a panic, everybody trusts the dollar as a knee jerk. But right now, I don't know. I think our debt level right now is $40 trillion. 40 trillion US. I think the outstanding debt in a slow economy of Japan is even worse in a ratio to GDP. I just don't have the numbers in my head. But we're at World War II levels. And we're going to lose the ability to print our dollar. Oil's no longer going to be priced in dollars. And we gave up all of this standing because we didn't want to be viewed as anti-Semitic. Well, I think we're the country in the world that has opened our arms. We were slow before the war. FDR was turning people back. But after the war, we opened our arms wider than any country in the world. And I don't see that there's any anti-Semitism in the United States. I think there was. But, you know, what positions are denied to anybody just because they're Jewish anymore? From finance to media to ownership of companies to, I just don't see it. I don't think there is anti-Semitism here. But of course, I'm not Jewish, so maybe I don't notice it. But we decided that we needed to side with Benji. And I tell you, we're going to pay a price for it. And I think what's going to happen, what you're seeing, unknown stuntsmen, on the carry trade, the whole idea is to borrow in yen and invest essentially in dollars or invest elsewhere. I don't know what's happening to yen rates. I don't want the exchange rate. I want the interest rate. I don't know how to get this answer. Anyway, I would imagine the yen is falling, rates are up, which is contradictory. Let me just search and see. I have no basis for the trend right now. I'll get a starting point there. But Steve, the thing is that our 10-year bond interest rates are going up. And I think our private credit markets are going to crack. They're already showing signs of cracking maybe because of data centers. I think Oracle's in trouble. And so these things can send shudders. And if our bond market, if our interest rates go over 5%, that's not good. And it could, the war itself, higher oil prices, higher food prices, panic, this can lead to a downturn in, well, there's what it is. The yen is surging. There's joint currency intervention. All right, so that goes to my other point. Anyway, if and it's going to happen. The question is it going to happen this year or next? But when the markets, in my judgment, when the markets give up the ghost from much higher levels, I think that 40 trillion debt that the United States have, and I don't know where the Fed is right now. I wish I could remember these numbers by I think it's around 10 trillion, less than 10 trillion, closer to 6. It won't give it to me. The national debt is 39.4 trillion. Okay, so I was wrong. It's 4.56 trillion. I thought it had gone up over 5 to 6 or something, 6 or 7. Anyway, I think in the next financial crisis that our federally outstanding debt will approach 100 trillion. Maybe not right away, but as we build our roads and our war machine, it'll go to 100 trillion. And I think the Fed's balance sheet could go as high as 50 trillion because they're going to act as the central bank for the whole world. So gold is going to soar. Oil and gas prices are going to soar. So that's one reaction. Now, let me get back to this experimental phase. The yen, so they together, the United States Treasury and the Japanese authorities engaged in a rare joint yen buying operations. The Bank of Japan sold almost 60 billion in US dollars to support the yen. They've kept their interest rate at 1%, but they're going to raise rates. So it's going to get more and more expensive to do the carry trade. You're going to have to pay more to borrow the yen, and then invest it elsewhere. And so there's probably some blowing up going on in that. The yen plummeted toward 164, hitting 40-year lows. Inflation concerns. Well, I'm going to move on, but I would tell you the it won't work. The intervention won't work. That's what I would say. The intervention won't work. So if they're making it go up now briefly, it'll be going down later. And I don't have enough information to give you the reason why, but I don't think interventions are going to work. I think ultimately the carry trade is not feasible, and there's probably unwinding on it, but that's my guess. Joe Marty, if I don't see $1 by October, I'm selling everything. I'm JK. I'm JK. Oh, I'm joking. I'm joking. I have more money clearing tomorrow, hopefully. Story hasn't changed, folks. Keep accumulating and stay strong. I'm glad you were joking, because I think it's going much higher than $1. But I can't, as I've proven, it's very hard to predict when. Very hard to predict when. October might be too soon. I think it's going to happen in September/October. But it might be too soon. All right. I'm going to quickly, I guess I'll grab a soda for the sugar, and then I'm going to be back. We're going to plow on. Joe Marty, holding for the long hallway, and that I know. Look, I've talked to a bunch of people. It's frustrating, but once you know what it's worth, you almost become toughened to what they do to the price. And it's not going to work. What they're doing to the price is not going to work. And I look forward to when this is worth $1 billion. Hopefully we can start a fund. I'm working on starting a fund and a company to what's the word? I don't know. The only word I can think of is vanguard, but that's a political word. But I'm working on all that. Can't wait, because we're going to have fun. All right, just give me just 1 second as I get a soda. I'm gonna put this up again because I do need the help, but I'll be right back. I don't know. It's frustrating me. Okay, let's throw this away. All right. Yep. Okay. Let's take that down. Don't know how to. There it is. I guess, Steve, the other thing I would say is warfare has changed. I think it's patently clear to everyone that you don't need to have the bloated budget we do on warfare. Smaller budgets like Iran's or Russia's that are focused on technology, drones, vibrations, and other things that I'm not even sure, maybe lasers, those things that, anyway, our ability to fight a World War II is not the future. So anyway, it means that once you separate military, undisputed military power from the dollar, it changes things. So there's a period of uncertainty. And perhaps that's why Trump is moving forward, is just to regain some semblance of dominance. Okay, we're going to move on in this challenge. And we're going to ask that same question to the girl. And see what she has to say. That's Gemini. Now, it's interesting. When I did this question, I didn't notice that I wasn't signed in. So this is the rudimentary answer from her. And it's interesting. We'll go through it. Okay, so I asked the same question. Can you give me a primer on who the mechanics? It's the exact same question. So essentially talking about high frequency trading in stocks under $5. What are the institutional cutoffs? Why is it allowed? Is there such a thing as a real market maker? You know, those kind of questions. The answers will show you what the question was. So her answer is here. The ecosystem surrounding sub $5 stocks and microcap companies outside institutional market cap thresholds operates as an extraction machine. She doesn't hold back. And remember, this is outside of any chats I've had with her. For retail shareholders caught in this structural web, the experience feels like navigating a rigged game where the rules, technology, and economic incentives favor everyone except the long-term investor. So part one, how, who, and the mechanics of high-frequency trading. Selling in microcaps. High-frequency trading and algorithmic market-making firms such as Citadel Securities, Virtue, Jane Street, and various proprietary trading shops dominate volume across virtually all equities. In sub $5 and microcap stocks, their mechanics shift from traditional liquidity provision to predatory harvesting. You know, a lot of this trading used to be done inside firms before, under Obama, they gave FDIC to the more gathering assets side. And then they created the prime brokerage side, which is the lending. But a lot of the prop desks and the so-called, you know, almost hedge funds inside the banks, they just went out and became hedge funds. So now they become the clients. Anyway, so high frequency trading and algorithmic market making firms dominate volume across virtually all equities in virtually across all equities, period. Everything's done by computer. In sub $5 micro cap stocks, their mechanics shift from traditional liquidity provision to predatory harvesting. Predatory harvesting. That's my opinion, and I'm glad she agrees with me. The Who. These are quantitative shops running low latency, high speed server arrays co-located at data centers such as Equinix NY4 in Secaucus, New Jersey. Well, they have these server arrays located in data centers where exchange matching engines live. So they match the orders with the exchange orders at a speed you can't even keep up with. The mechanics. In heavily traded large caps, HFTs profit on razor thin bid-ask spreads via volume. In micro caps, liquidity is sparse and the order book is thin. When a retail buy order hits or a positive press release drops, HFT algorithms detect the microscopic imbalance. The algorithm's trap. Because microcap order books lack depth, HFTs or affiliated algorithmic desks front run or step in front of incoming orders. Illegal. They use momentum ignition strategies, triggering automated selling sequences the moment a stock hits resistance or volume fades. Resistance is all those charts that all those boys try to get you to listen to them on. They sell shares short into any upward blip, forcing retail stop losses and downward cascades downward. And then they cover at lower prices. Swell. It's really swell. And part two, the bona fide market maker versus modern HFTs. Historically, a bona fide market maker, a BMM, big man in motion, had an affirmative legal obligation under exchange rules, to maintain a fair and orderly market. They had market makers had to buy when everyone else was selling and sell when everyone else was buying. The market maker's job was to absorb inventory risk in order to ensure continuity. The modern HFTs, so-called market makers, operate under a different reality. That may not surprise you. Whilst they must register as market makers to secure the exemptions from certain short sale rules, for example, such as easier access to locate shares under Reg Show or just lying under Reg Show, while they they do have to register, they also maintain the modern HFT so-called market makers maintain no structural obligation to support a falling stock. The moment volatility spikes or a microcap stock trends downward, their algorithms pull quotes instantly. They back off. They provide liquidity only when it is mathematically risk-free, and they vanish the exact second a company needs a backstop. This is what we traded for. And my opinion is that the system, whatever you want to call it, slowly moved this agenda forward. And they got there. They got where they wanted to be. From the thundering herd, that's a reference to Merrill Lynch, to the algorithm. The golden era of equity markets relied on a human infrastructure that has been systematically dismantled. For example, the specialists. On floors like the New York Stock Exchange, human specialists managed specific posts. They understood the fundamental story of the companies they traded, and they used their own capital to smooth out order imbalances. Those specialists have been replaced by silent server rack matching machines, server racks. Where'd the thundering herd go? Regional brokerage firms and retail networks, Merrill Lynch, Dean Whittier, E.F. Slutton, once employed armies of brokers who built relationships with retail clients. They championed small cap IPOs, and they distributed real fundamental research at Merrill Lynch, Dean Witter, E.F. Hutton, and companies like that, and regional brokerage firms. Today, research has been replaced by the fake and manipulative report. Today, independent microcap research has largely been replaced by, quote, pay to play, unquote, promotional boiler rooms. Companies desperate for attention, and you can't fault them for this, as long as they're disclosing it and being honest, you can't fault them. Companies desperate for attention pay stock promoter networks to distribute glossy, now I don't like this, overly optimistic reports disguised as independent analysis, which serves primarily to create liquidity for insiders or toxic lenders to exit. Not all companies are doing it for insiders. Not all companies have signed toxic notes or intend to let toxic lenders exit that way. But we've got to be aware of this. I would say this applies to at least 80% of the microcap companies out there. Payment for order flow, front running, and the SEC. The retail broker promise of, quote, free commissions is an illusion. It's an illusion. I love this girl. Paid for the structural disadvantage, paid for by the structural disadvantage of the customer. Payment for order flow, PFOF, retail brokers route non-directed retail orders to wholesale market makers like Citadel Securities, rather than sending them to public exchanges. These wholesalers pay the broker a fraction of a penny per share for the right to trade against your order. So your own trade against retail flow. So your broker is giving your order to one of these shady intermediaries so they can trade against you. That doesn't sound good. I'd rather pay commission. There is information asymmetry. Wholesalers, Citadel, they see the retail buy and sell pressures milliseconds before it hits the broader market. In illiquid sub $5 stock, this visibility allows a company like Citadel to anticipate price direction, managing inventories at the expense of the retail investor. The SEC and the revolving door. The SEC has largely neglected the over-the-counter OTC and microcap ecosystems, treating them as Wild West peripheries, unworthy of deep resource allocation. This regulatory neglect is compounded by the revolving door. Top SEC officials, enforcement attorneys, and economists routinely leave regulatory posts to take lucrative legal or executive positions at major Wall Street institutions, major high-frequency traders, or defense law firms. The resulting defense, as in defending Wall Street, the resulting regulatory capture ensures that rules protecting market structure are written, with loopholes wide enough to drive a trading desk through, if trading desks existed anymore. I like her answers. And remember, this chat here, it has no access to any other work I did with her. This is unsigned in. So I love her answer. And it shows that different AI has different probably different search engines, different parameters. Part 5, is NASDAQ a jewel or a capital stripping machine? The NASDAQ used to be the incubator for high growth technological innovation. Couldn't have said it better myself. Today, for microcaps, it frequently functions as a gilded trap. I used the word gilded in my question. Companies race to list on the NASDAQ to capture institutional credibility. But once listed, They face brutal minimum price rules, $1 threshold, and market cap maintenance requirements when their share prices inevitably slide because of operational burn or predatory shorting. These companies become desperate. In order to stay listed, they enter into toxic financing loops, turning the exchange listing into a mechanism that continually strips capital from equity holders to satisfy debt holders with a massive cost to the bird dog financiers. Part 6, toxic financings, ATM offerings, and legal engineering. How do companies end up in death spirals? The CEOs sign them. That's how. Through financial engineering that turns standard debt into predatory traps. How does it happen? Well, there's at the market ATM offerings. While legitimate for large caps with deep floats, microcap ATMs allow a company to continuously drip newly issued shares directly into the open market via an agent. You know what they should do is get rid of the agent and let the company just do it on its own. But anyway, they do it via an agent, instantly diluting existing shareholders and overwhelming any natural buying demand. That's an ATM that makes sense. And we've gone through this so many times in the big names. It's just a license to strip you of your capital and strip the company of any hope. Floorless, that's floorless convertible notes. Lenders provide cash-starved companies short-term notes that convert into common stock at a massive discount to the market price. For example, 30% to 50% off with no price floor. I love this girl. She's doing a great job right here. Same question, better answer as far as I'm concerned. The legal loophole. Attorneys draft those notes or these notes using complex legalese that shields the lenders from standard usury laws. When the lender converts debt into cheap shares and immediately dumps them onto the market, I think they've already been dumped, but okay, let's keep going. Crushing the stock price, the mathematical result is an effective annualized interest rate well past triple digits. Yet, in court, the contract is ironclad, leaving the blame squarely on the shoulders of management who signed away the company's lifeblood out of desperation. Where do grassroots companies go? Where do trades occur? American grassroots companies seeking fair price discovery are largely out of options. Traditional venture capital ignores public microcaps, and traditional commercial banks will not lend to pre-revenue or to distressed public entities. The shadows, a massive volume of trading in microcaps and stressed equities does not occur on transparent lit exchanges. Lit, not stoned, lit out in the light like NASDAQ or NYSE. Instead, that massive volume of trading happens in dark pools and internalizer networks operated by wholesale market makers. Remember, that's Virtue, Jane Street, Citadel, etc. This fragmentation hides. How can this be true price discovery when it hides institutional buying? This fragmentation hides institutional accumulation and distribution from the public tape. How can that be fair? Leaving retail shareholders blind to the true supply and demand dynamics. How is that enough disclosure? No standing for retail. Retail shareholders possess virtually zero legal standing to challenge market manipulation, predatory short selling, or abusive corporate governance directly under most securities laws. Private rights of action are severely restricted. Enforcement is almost exclusively the monopoly of the SEC, which rarely acts on microcap manipulation until the damage is total. I love her answers. Part 8, the doom loop. For a struggling microcap company, the market psychology is inverted. Good news as exit liquidity. When a company announces a major contract, a drug approval, or positive clinical data, retail investors rush in to buy. Algorithms instantly recognize this surge in retail buying volume, as an opportunity. High-frequency traders and toxic note holders use the artificial liquidity generated by the news spike to dump shares, to crush the rally, and to drive the stock lower than where it started. The only way out? Short-term momentum, retail hype, and press releases no longer work. Short-term momentum, retail hype, and press releases no longer work because the algorithmic machinery eats those alive. Sustained institutional sponsorship driven by a fundamental shift in NAV, net asset value, massive verifiable revenue, or transformative structural catalyst is mathematically required to overwhelm the selling algorithms. I think that's what you're in. How can honest shareholders fight back? When an honest group of long-term shareholders finds themselves trapped in a dying microcap, traditional trading strategies fail. Survival requires structural intervention. Structural. So shareholders should demand transparent share counts. Well, I know the MMTLP community has asked that. Never get it. So retail should push management relentlessly for full transparency on toxic convertible debt, warrant overhangs, and actual share dilution metrics. I don't think there's much we can do on this, but we can be in touch with management, challenge what they're doing, and then get at least a gut reaction and a commitment that they're not doing this. Anyway, proxy activism. Form shareholder coalitions to block toxic, floorless, convertible debt authorizations at annual meetings. That's a great idea. We should go to the annual meetings. Starve the death spiral financiers of new shares to issue. I love that. But it's so hard to do because even in the shareholder vote, it's not one share, one vote because they've lent it out 20-1. It's all, I don't know. They look the other way on governance. Move to direct registration. We've learned that. Removing shares from the street name via the transfer agent, for example, Computer Share Equinity, and registering shares directly in the shareholder's name, that prevents brokers and market makers from lending out those shares for short selling. Of course, you can't participate in a short squeeze, but I think in the long run, it's more sensible. Litigate corporate malfeasance. Well, we don't have the money. If management knowingly enters into criminally usurious or fraudulent toxic financing agreements that explicitly violate state laws, that's very hard to prove, but I guess we should be on the alert for it. Shareholder derivative suits can sometimes force companies to invalidate toxic notes, as seen recently in successful challenges invoking state usury defenses. I think Mark Bazile got one or two of those done. Are CEOs required to look out for shareholders or for the company? Listen to this. Under corporate law, most notably anchored by the legal standards of Delaware, where the vast majority of U.S. public corporations are incorporated, CEOs and boards of directors owe their primary fiduciary duties to the corporation and its stockholders, shareholders, as a collective body. In everyday practice, courts treat the company and the shareholders as deeply intertwined, but the legal reality involves specific frameworks, nuances, and dangerous loopholes that have a heavy impact on microcap companies. Core fiduciary duties. Directors and officers are bound by true primary fiduciary duties. Duty of care. The obligation to act with the level of care that a reasonably prudent person would use in similar circumstances. This means doing due diligence, reading contracts, would you imagine, consulting experts, and not acting with gross negligence. Duty of loyalty, the obligation to put the interests of the corporation and its shareholders ahead of the CEO's interest or the director's personal financial interests. This prohibits self-dealing, insider trading, and corporate theft. Good luck to proving any of it. The nuance, the company versus the shareholders. While the state laws state that directors must maximize long-term shareholder value, the legal entity they serve is the corporate entity itself. In normal, healthy operating conditions, looking out for the company means looking out for shareholders. because a healthy company generates equity value for its owners. However, a major legal distortion occurs when a company enters financial distress. A common reality, unfortunately, for sub $5 microcap companies. The shift in insolvency. When a company becomes insolvent, unable to pay its debts as they come due, the legal paradigm shifts. Under established case law, such as North American Catholic Educational Programming Foundation, Inc. versus Giwala in Delaware, the fiduciary duties of the board expand to include creditors. They should leave that to the bankruptcy court. When a company is on the brink of bankruptcy, the board's duty is no longer purely about maximizing equity value for shareholders or even preserving it. It's about preserving corporate assets to ensure creditors get paid. Okay, well, how does toxic financing do that? You just take on a new creditor. How CEOs hide behind the company in toxic financings. In microcap and sub $5 death spirals, struggling CEOs frequently violate the spirit and sometimes the letter of their duties to shareholders by claiming they are saving, quote unquote, the company. The justification: a CEO signs a predatory, floorless convertible note or an aggressive ATM at the money toxic financing agreement with the argument, quote, if I didn't sign this toxic loan today, the company would run out of cash and declare bankruptcy tomorrow. Therefore, by diluting shareholders into oblivion, I saved the company, unquote. I think that should be a wrong, and I think it should be jailable. But good luck. The legal shield, the business judgment rule. Courts are historically reluctant to second guess business decisions made by management. Under the business judgment rule, judges assume that directors acted on an informed basis, that they acted in good faith, and that they acted with the honest belief that the action was in the best interests of the company. Well, there you go. Glad we got that settled. As long as the CEO can claim they signed a bad deal out of sheer desperation to keep payroll funded, courts will rarely hold them personally liable for destroying a shareholder vote. Does that payroll include themselves? Is that a conflict of interest? I guess not. I guess not. Not when you have the lawyers and the judges all in your pocket. So what's the shareholder recourse, direct versus derivative claims? If a CEO or board acts against shareholder interests, retail investors face steep procedural hurdles to hold the CEO and board accountable. Direct claims, lawsuits brought by shareholders alleging direct harm to their individual property rights, i.e. being blocked from voting or manipulation of a specific stock class. These are difficult to win for general stock price declines. Yeah, it's all difficult. Derivative claims, lawsuits brought by shareholders on behalf of the corporation because the management board breached their duties to the company. That's an interesting angle. If successful, any recovery goes back into the corporate treasury, not directly to shareholders' pockets. Furthermore, proving that a board acted with gross negligence or disloyalty rather than just making a terrible business decision under duress requires an extraordinarily high burden of proof. Ain't happening. It ain't happening. All right, got one question. Joe Marty says agreed. Oh, I forget what I said, but I'm sure it was smart. KYP, hey Billy, you live today. Thank you. You're welcome. Good to see you, KYP. All right. So I have to press on. I've got a big job today, and somebody got me into it. I told you, I promised I would do my best to work hard in August. You need the distraction. We need to learn. And we need to learn how to make money in this. We got to stop fooling ourselves that the SEC gives a fig. All right, so who is this? I think this is back to ChatGPT, but here. This is where I start. Here's the question that I'm asking each one. Can you give me a primer on how, who, and the mechanics of high frequency trading, selling in stocks below $5 and under institutional cutoffs for the market cap? Can you discuss bona fide market makers? Who are they? Why should stocks which would otherwise trade by appointment be subject to computerized selling? Discuss how humans firms used to provide real market making, real research, and real thundering herds of retail brokers to recommend stocks. Where have specialists gone? The fake, the manipulative research talk about, the front running by Citadel in order to give, quote, free commission, the complete abandonment by the SEC and the OTC in terms of monitoring or policing, the revolving door at the SEC, discuss whether the NASDAQ is the jewel it once was, or just a gilded way to strip shareholders of their capital. Is disclosure of the risks here adequate? Why are attorneys allowed to end run every rule in their attempt to create ATMs and toxic financings? Financing which, in simple English, are usurious, but in legalese, they are the CEO's fault. Where can American grassroots companies go to get a fair shake at financing, price discovery? Why do trades occur in the shadows? Why is there not one item that gives retail shareholders standing in the markets? Discuss the tag-alongs, the sharks that short all of these doomed companies. Discuss how news, press releases, anything good will be met with a rush of buying, which then just feeds the computerized algorithmic program selling beast. It seems institutional buying sustained is the only way out. What causes that? Is it changes in NAV, drug approval that is final and big, huge verifiable contracts and revenue? If any news gets crushed by share price, How can an honest group of shareholders help a company get out of this? We're caught in a trap. We can't get out because I love you, baby. Don't you know we're caught in a trap and we can't get out? Okay, the mechanics. I think this looks like Claude, the Frenchman. This, I think, my friends, is the Frenchman. HFT and algorithmic flow in these stocks is mostly passive liquidity provision mixed with opportunistic inventory management and short-term mean reversion or momentum strategies. Now, one thing about the Frenchman, I guarantee you this, he's going to play the devil's advocate. He's never going to agree that anything bad is going on. But he doesn't tolerate making any conclusions that he can't see the evidence for. So who? Firms such as Citadel Securities, Virtue, Jane Street, Susquehanna, and smaller electronic market makers. Many also act as OTC market makers on the pink sheets, OTC QB. They quote continuously because the maker-taker or spread capture economics plus any payment for order flow rebates can still be positive on high message volume, even if average daily volume is only tens or hundreds of thousands of shares. I wonder what high message means. Oh, I see. When there is higher volume, I guess. How the selling works. When a positive press release or retail buying wave hits, limit order books temporarily fill on the bid. Algorithms detect the imbalance. The algorithms lift offers or short into strength. Then work the inventory off over minutes to hours. Because depth is shallow, a relatively small notational sell program can push the price by 10 to 30% or more. Program selling is often just inventory management or statistical arbitrage against correlated names, not a coordinated attack. In the darkest names, volume can be almost entirely internalizer, Citadel, market maker flow. No, there's no real such thing. Rather than genuine investor to investor matching. Exactly. No price discovery. Why stocks that should trade by appointment still have continuous HFT quotes? Continuous quoting is cheap electronically. It is cheap. The alternative, true auction by appointment, would concentrate risk and reduce the ability of brokers to offer instant execution to retail. Regulators and exchanges have favored continuous markets for decades. The result is the appearance of a liquid market that can vanish or reverse violently on modest size. Bona fide market makers still exist and have affirmative obligations on NASDAQ. And designated market makers or lead market makers have some continuous two-sided quote requirements. On OTC, there are less stringent standards. I love my French man. Many electronic firms, however, quote only when it's profitable and they can widen or withdraw rapidly. They are not the old specialist who was expected to lean against the wind with capital and with judgment. Against the wind. Historical context. Specialist research and retail distribution. There you go, pre-decimalization and pre-electronification. New York Stock Exchange specialists had affirmative obligations. They stood in the crowd and they were expected to make orderly markets. Regional exchanges and the NASDAQ market maker system, which was multiple dealers posting two-sided quotes, provided human intermediation. The multiple dealers were brokerage firms, and you had the trading desks inside the firm. That's what it was to be a market maker. Trading desk, research, they interacted with the sales force. It's all gone. Sell-side research coverage of small companies was more common because commissions were higher and bundled research was viable. Retail broker networks, thundering herds, actively distributed stories and stocked individual investors. Most of that infrastructure has atrophied. Most of that infrastructure has atrophied. Specialists as a class largely disappeared after the New York Stock Exchange moved to designate market makers with weaker obligations and after electronic matching became dominant. Independent research for sub-$300 million companies is rare and often low quality or promotional because economics do not support it. What remains is frequently issuer paid or from small boutique firms with conflicts and really no sales force. What used to happen is you'd have your research inside of a respected firm. You'd have a sales force that got to know that analyst through calls, through trips, through road shows, and what he or she said mattered. But now it's all gone. So when these small firms come out with research, it doesn't lead to buying. Commission compression and the rise of zero commission retail brokers removed the revenue that once supported distribution and research. Payment for order flow, quote, free commissions, and Citadel. Payment for order flow is legal and disclosed, according to the Frenchman. Retail brokers route most marketable orders to wholesalers. Citadel Securities is the largest in exchange for payments. Critics argue this creates adverse selection and information advantages for the wholesaler. Defenders note that it subsidizes zero commissions and that execution quality metrics are published. Allegations of pure front-running of customer orders are serious, and if proven as illegal trading ahead, would be securities fraud. Regulators have scrutinized but not banned this model. The practical effect for microcaps is that a large fraction of retail flow never hits public exchange and is internalized, reducing displayed liquidity and price discovery. I'm having a second thought on who this is. There's Gemini, there's Musk, there's OpenAI, and Okay, we did open chat GPT first. We did Gemini. And then there's this actually, I think, is I think these answers are from the Afrikaner. I think I was wrong. I think this is actually answers from, I'm trying to think of the name of what he has. The one that's linked to X. So it's not the Frenchman, it's the Afrikaner. They all look the same when they print out. So payment for order flow is legal and disclosed. Retail brokers route most marketable orders to wholesalers. Citadel is the largest in exchange for payments. Critics argue this creates adverse selection and information advantages for the wholesaler. Defenders note that it subsidizes zero commissions and that execution quality metrics are published. Allegations of pure front running of customer orders are serious, and if proven as illegal, trading ahead of the order would be securities fraud. Regulators have scrutinized but not banned the model. The practical effect for microcaps is that a large fraction of retail flow never hits a public exchange and is internalized, reducing displayed liquidity and price discovery. So this is Grok is what it is. This is Grok. This is Grok. OTC oversight, SEC priorities, and the revolving door. The SEC's resources and enforcement priorities have long focused more heavily on larger markets, exchanges, and registered investment advisors than on the deepest OTC layers. Pink sheets and many OTCQXQB names have lighter disclosure and surveillance. Abandonment, that's my word, is an overstatement. Rules still exist. Reg show for shorts. Laughable. Rule 15C2-11 for quotations. But enforcement intensity and real-time monitoring are thinner than for national market stocks. The revolving door is real and documented across administrations. Senior SEC staff and commissioners frequently move into industry law firms, exchanges, or trading firms, and vice versa. This is not unique to securities regulations. It raises legitimate questions about incentives and capture without proving every specific outcome is corrupt. Yeah, this is Grok. I'm recognizing his voice. NASDAQ remains a high-quality listing venue for companies that can meet and maintain standards, but the lower tiers and the surrounding OTC ecosystem contain many serial diluters and failing businesses. Risk factor disclosure in SEC filings is extensive. Whether it is adequate in practice for retail investors who do not read 10Ks is debatable. The legal system treats sophisticated investors differently from retail. That's true. ATM, at the market offerings, and structured pipes, that's private investment, public entity, convertible notes are often the only capital available to microcaps who cannot access traditional equity or debt. They are frequently, these forms, highly dilutive and can contain features such as floating conversion rates, prices, and make wholes that amplify downside. Lawyers structure them to comply with existing rules, registration statements, Section 3A9, and so on. Calling them usurious captures the economic reality for existing shareholders. The legal form usually places formal responsibility on the board and management that approve the terms. These structures thrive because conventional financing is unavailable, itself a symptom of the liquidity and research vacuum. Where grassroots companies can get a fairer shake. Options are limited and imperfect. Stay private longer and use venture, private equity, or revenue-based financing. List on higher quality foreign exchanges or use Reg A+, crowdfunding with real ongoing disclosure. Attract a genuine strategic or institutional anchor that can stabilize the float. Build actual revenue and cash flow so that the company is no longer forced into continuous dilution. Price discovery improves only when real capital with longer horizons arrives. Continuous electronic quoting alone does not create it. And Grok continues, dark trading, retail trading, shorts, and news dynamics. A large and growing share of U.S. equity volume, often greater than 50%, 40 to 50% in recent years, occurs off exchange. Can you believe they allow it? How can that be real price discovery? Occurs off exchange in dark pools and internalization. For microcaps, the percentage can be higher, believe it or not. Retail shareholders have limited formal standing beyond the usual 13DG proxy and appraisal rights. They cannot easily force better market structure. Short sellers and tag-along opportunistic traders are rational actors in a market that repeatedly produces serial dilutors and zero revenue stories. Some are pure predators. Many simply fade strength in names with poor fundamentals. That's true too. Naked shorting is restricted by Reg Show, yeah, though fails to deliver still a cure, and though they are monitored. Positive news frequently produces a retail momentum spike that algorithms and market makers fade. The pattern is well documented. Buy the rumor, the news, sell the reality of thin books and ongoing dilution risk. Yep. Sustained institutional buying usually requires a fundamental change that alters the risk reward for larger funds, such as final regulatory approval with a clear commercial path or verifiable multi-year contracts that change cash flow trajectories, or a clean balance sheet, or a change of control situation, which is why that's it. In a lot of the contracts, that's a event of default, like the one Martin Shen signed. If they change control, event of default. If they change the CEO, event of default. Or they have to do it with their approval. That's all by memory. Check it out. Make sure I'm right. Without that, sporadic good news is just more inventory for the electronic sellers. See, this is where um, the Afrikaner is being fair. That's right. Sporadic good news is just more stock inventory for the electronic sellers. That's exactly right. Can honest shareholders help? Collectively, they might demand better disclosure and capital structure discipline from management, vote against serial dilutive deals where possible, support or withhold support for management teams that repeatedly choose toxic structures, concentrate ownership enough to matter in governance, though this is hard in widely held microcaps. Recognize that many of these companies are structurally uninvestable. Many of these companies are structurally uninvestable until the business changes. The core problem is not solely HFTs or Citadel. The core problem is the combination of one, zero, this sounds like me, zero traditional research and distribution economics for tiny companies. Two, continuous electronic markets which amplify thin book volatility. Three, ready availability of dilutive structured capital. And four, a regulatory and listing regime that allows many marginal issuers to remain public. Fixing any one piece without addressing the others produces limited improvement. For an individual microcap, the only durable exit from the pattern is usually a fundamental improvement large enough to attract patient capital that can overwhelm short-term algorithmic flow. He's kind of in the middle. He's good. Of course, I'm so negative on all this. So this NMS was adopted 2005 and fully phased in 2007. It imposed a largely uniform national market system framework on all exchange-listed equities. Its core components are Order Protection Rule, Rule 611, the Trade-Through Rule, the Access Rule, Rule 610, the Sub-Penny Rule 612, and market data reforms. The stated goals were stronger protection of the best displayed prices, fairer access to quotes, limits on sub-penny quoting games, and improved transparency competition among trading centers. For liquid large cap stocks, these changes generally tightened spreads, accelerated electronic competition, and reinforced retail confidence that marketable orders would not systematically trade through better protected quotes. For microcaps and other thinly traded names, the effects were more mixed to negative because NMS applied essentially the same architecture to stocks that trade continuously with deep books to those that trade episodically with shallow depth. NMS does not differentiate meaningfully by liquidity tier. A stock that prints a few thousand shares a day is subject to the same intermarket protection, access, and quotation rules as one that trades millions. SEC commentary and market structure analysis have repeatedly noted the mismatch. Institutions are deterred from participating because posting a meaningful bid can in and of itself move the price or signal intent. And the order protection rule can force interaction with small protected quotes across multiple venues before a larger order can be worked. It's just all, in my opinion, it's all rigged so that they can continue the theft. But, it's all carefully worded, and lawyers are so honest. The result is greater fragmentation of an already scarce liquidity. Volume splits across exchanges, ATSs, and internalization. Display depth at any single venue is thinner, and the continuous two-sided quote that electronic market makers provide can evaporate quickly once inventory risk rises. Now, the good side, when buying comes in, that ability that you have right now to buy 10,000, 20,000, 50,000 shares, even 100,000 shares at a clip of Railtown is going to disappear. Traditional capital committed market making, where a firm stood ready traditionally to lean against order flow with its own balance sheet, became far less attractive once decimalization was combined with NMS's electronic top of the book protection model and the 1 cent tick. There's nowhere to hide mistakes anymore. You can't eat mistakes and make it up down the road. Larger percentage ticks relative to price would have been needed to restore economic incentives for true intermediation in low volume names. The 1 cent minimum, with limited exceptions, did not provide that. Law of unintended consequences, maybe. Order Protection Rule 611 requires trading centers to avoid trading through protected, in other words, immediately accessible, automated, top of the book quotations in thin names. This can force routing of even modest institutional or algorithmic flow to tiny quotes on low volume venues, increasing signaling risk, latency, and the chance that the remaining size is then left exposed. Critics have long argued this contributed to venue proliferation. I can see that. That's something that needs to be fixed. And complexity that raises connectivity and compliance costs without commensurate depth gains for illiquid stocks. I can finally see an argument that I understand on the other side. As of mid-26, the SEC has proposed rescinding Rule 611 and the locked cross prohibition in Rule 610, citing these fragmentation, complexity, and institutional trading costs. The proposal remains open for comment. Maybe we should comment. Access and fee structures. Access fee caps and market maker taking pricing encourage high message traffic and rebate driven liquidity provision. I don't know what the heck. In microcaps, the liquidity is often fleeting inventory management rather than patient capital. Sub-penny and tick constraints. The original 1 cent floor, later partially relaxed, interacted poorly with low absolute prices. When a stock trades at 50 cents to $2, a 1 cent tick is economically large. When it trades higher, the same tick can become too coarse relative to economic spreads, producing the opposite problem of tick constraint. Recent NMS amendments since 2024 have begun allowing half penny ticks for certain stocks and adjusting access fee caps and round lot definitions, acknowledging that the 2005 calibration had become outdated. Empirical patterns consistent with these mechanics include narrower quoted spreads overall after NMS and decimalization, often more pronounced in percentage terms for smaller names on small trades, but reduced display depth, which isn't great, higher relative costs for size, more episodic liquidity, and a secular decline in traditional market making capital allocated to small cap names. So I think they are abandoned or orphaned. Research coverage and institutional ownership thresholds also suffered as the economics of intermediation and information production deteriorated. NMS accelerated the shift from quote-driven, capital-intensive intermediation to electronic order book and proprietary HFT models. That shift works well when natural two-sided flow is abundant. That's up in the big names, in a Tesla or an Apple. It leaves micro caps more dependent on opportunistic electronic liquidity that can disappear or reverse on modest news or retail waves. Capital formation for the smallest public companies became harder because sustained visible liquidity, the kind that supports secondary offerings, research, and institutional entry, was harder to maintain under the one-size-fits-all rules. Related but distinct developments, NASDAQ continued listing standards, Rule 15C2-11 OTC reforms, and so on, have further narrowed the public market runway for the weakest microcaps, partly in response to manipulation and volatility concerns that thin books amplify. Those are not pure NMS effects, but they interact with the market structure environment that NMS helped create. In short, regulation, Nancy Mary Sam, delivered clearer intermarket price protection and more intense competition for liquid stocks. For microcaps, it reinforced a structure that treats episodic, low-volume securities as if they were continuous, deep markets, thus contributing to fragmentation, to the atrophy of traditional market making, and to higher effective frictions for anyone trying to accumulate or exit meaningful size. That's in probably institutions. Ongoing SEC proposals to revisit the order protection rule and earlier tick size access fee calibrations reflect recognition that the 2005 design has material shortcomings for the lower end of the liquidity spectrum. And my guess is institutions, not retail, are getting that pushed. No, I asked the question, is the NASDAQ great? No, qualifying for the NASDAQ is rarely the panacea many microcap CEOs imagine. CEOs often treat a NASDAQ listing, especially capital market, as the inflection point, which will deliver prestige, better liquidity, institutional access. On Railtown, there's a guy pushing for that, and it's a mistake. Research coverage, easier follow-on capital, and provide escape from OTC stigma or trade by appointment dynamics. In practice, in actuality, for the typical small or marginal issuer, those benefits are partial at best and frequently are outweighed by new costs, risks, and the same structural market problems that exist off exchange. What actually improves sometimes. Uplisting from the OTC can produce measurable gains in market quality. Difference in differences studies of firms that move to the NASDAQ NYSE or NYSE American show improved liquidity, tighter spreads, better price discovery, and lower volatility relative to matched controls that stayed OTC. Continuous two-side quoting, consolidated tape visibility, and the exchange rules do create more reliable displayed markets than the deeper pink or expert market tiers. Expert market, that's just completely uninvestable. Expert market is completely uninvestable. And I assume the deeper pink is too. NASDAQ itself highlights tighter spreads, greater depth, and closing auction liquidity for companies that switch or list there. For companies that already have real revenue traction, you already have to have that, clean capitalization, and a path to institutional size, the listing can serve as a useful credibility signal, and it can lower the friction for later capital raises or strategic transactions. All right, I'll give it that. I have to give it that. Can't always be negative. Sometimes you have to be positive. All right, I think that's it. What usually does not happen on the NASDAQ, real sustained institutional ownership remains rare. Many microcap NASDAQ names still show single-digit institutional ownership. Funds have hard market cap liquidity and coverage thresholds. A NASDAQ ticker alone rarely overrides them. Liquidity is often still thin and algorithmic. Daily dollar volume for a large share of microcaps stays in the low hundreds of thousands or less. The same HFT market maker inventory management, to put it politely, news fading, and shallow book volatility described earlier continues. Positive press still frequently produces a short-lived retail spike followed by electronic selling. Research, coverage, and distribution do not magically appear. Sell-side economics for sub $100 to $300 million names remains poor. Promotional or issuer-paid research is still common. Capital access stays difficult on the NASDAQ and often is dilutive. ATM, structured convertibles, and pipes remain the default tools. Listing standards do not eliminate the need for continuous financing if the business is crash burning. Post-listing performance has frequently been poor. Cohorts of recently small IPOs have shown high average drawdowns. One 2022 analysis of microcap exchange listings found 65% average declines, and the large majority underwater in any event. Median institutional ownership in some groups was only approximately 4%. Rising barriers and faster downside. NASDAQ has steadily raised the bar precisely because too many low quality or speculative listings damaged the brand, not any more than Adina Friedman in my judgment, and invited manipulation concerns. Higher public float requirements, now generally $15 million from IPO proceeds alone for many issuers, eliminating prior loopholes that counted legacy shares, accelerated delisting for market value of listed securities below 5 million for 30 consecutive business days, no automatic cure period, limited appeal relief, and immediate suspension risk. Expanded discretionary authority, the IM 51013 rule, to deny listings even when quantitative standards are met. Tighter rules for China-based or restrictive market issuers. The practical result in 2026 has been a sharp drop in microcap IPO volume. Companies that do list faced higher ongoing compliance, governance, audit, and listing fee costs relative to their size. Falling below continued listing standards often forces reverse splits, further dilution, or rapid slide back into the OTC, where liquidity and visibility can collapse further. Bottom line for CEOs, NASDAQ qualification is a necessary condition for certain institutional mandates, index consideration, and cleaner secondary market optics. NASDAQ qualification is almost never a sufficient solution to the core problems of thin natural liquidity, electronic inventory management, short interest, and serial dilution. The companies that benefit are those that already possess or rapidly develop verifiable commercial traction. So that's one thing to look at. A clean balance sheet, another thing, and a capital structure that does not require constant toxic financing. For the rest, the listing can accelerate the visibility of the very dynamics that trap shareholders. So listing on the NASDAQ can accelerate the dynamics of algorithmic selling into strength, opportunistic shorting, higher fixed costs, and a steeper path to delisting if the market loses interest. Real escape from the pattern still requires the same fundamentals discussed earlier: material change in cash flow trajectory, large verifiable contracts, regulatory catalysts with commercial clarity, or an anchor institutional/strategic buyer willing to absorb size. The exchange badge helps NASDAQs only after those elements are present. So I said untangle is CEO's duty and the board. And whether or not attorneys have warped it over time. And do CEOs violate their duty by signing these obvious death knell financing? So here comes the answer: no. The core fiduciary duty of directors and derivatively of officers is to the corporation and its stockholders. In a solvent company, the residual owners are the common shareholders. So the duty is to act in their best interest, typically framed as maximizing the long-term value of the corporation for their benefit. Delaware law, which governs most U.S. public companies, is clear on this point. The quote, company must survive or shareholders get nothing, unquote, framing is not a judicial rewrite of the duty. It is a practical recognition of residual claimant economics, unbelievable, when a firm is distressed. Legal standard, not a slogan. Directors owe two primary duties: care, informed, deliberate decision-making. The process matters more than the outcome. Loyalty, no self-dealing or bad faith prioritization of personal interests over the corporation's. Courts review most board decisions under the business judgment rule. If the board was independent or the conflicted members recused, informed itself reasonably, acted in good faith, and was not self-interested, the decision is protected even if it later looks disastrous. Shareholders challenging a financing must usually plead particularized facts showing the board's process was grossly negligent or that loyalty was breached. It is a high bar. When a company is insolvent, or in some analyses, deep in the zone of insolvency, directors may consider the interests of creditors as the residual claimants, but the duty remains to the corporate enterprise. Equity holders do not lose all protection. They simply share the residual position with the creditors. Creditors go first. Delaware has rejected expansive duties to creditors that would allow easy attacks on ordinary business decisions. Oh, I see. In the context of making decisions outside of the bankruptcy court, I see what they're saying. The survival first framing appears in microcap or distressed public companies. The realistic alternatives to a highly dilutive financing are often immediate or near-term bankruptcy or liquidation, in which common equity frequently recovers zero after secured and unsecured creditors, or continued cash burn until the same outcome with no new capital available on better terms. Under those facts, a board can rationally conclude that preserving a going concern option, even one that transfers most of the upside to new capital providers, still offers equity a non-zero, even if remote, chance of recovery. Courts have repeatedly upheld such decisions when the board explored alternatives, obtained independent advice, and documented a good faith belief that the deal was the least bad path. The attorneys are not inventing a new duty. They are advising clients how to create a record that invokes the business judgment rule. That does not mean that every toxic financing is automatically protected. A deal can still be challenged successfully if the board failed to inform itself, no market check, no independent financial advisor, no serious exploration of alternatives. If controllers or management extracted personal benefits, continued salaries, change of control protections, option resets, or side deals that were not shared with other shareholders and were not entirely fair, the transaction was so one-sided it constitutes waste or bad faith. Rare, but possible when the terms are extreme and process is non-existent. Disclosure to shareholders was materially misleading. In those cases, the standard can shift to entire fairness, and the defendants bear the burden of proving the deal was fair in both process and price. Practical reality for CEOs and boards. CEOs propose, boards approve. A CEO who pushes an obviously value-destroying financing primarily to keep his job and salary while transferring residual upside to new lenders or investors can create loyalty problems for both himself and any directors who rubber stamp it. Directors who simply CYA without real deliberation are not insulated. But the existence of personal consequences, job loss, reputational damage, litigation, does not itself prove a breach. The law looks at whether the decision process and purpose were oriented toward the corporation's residual value. In the microcap world, the deeper problem is usually earlier. Weak business models, serial dilution already baked into the capital structure, absence of traditional financing options, and thin markets that make orderly capital raises difficult. By the time a death knell convertible or an ATM is on the table, the board's realistic choices are often narrow. Shareholders who want better outcomes generally need to act before that point through governance pressure, concentrated ownership, or refusing to support management that repeatedly chooses highly dilutive paths without credible plans to reach sustainable cash flow. In short, the duty is to shareholders as residual owners of a solvent corporation. The survive so there is something left argument is frequently a correct application of that duty under distress, not a corruption of it. CEOs and boards can still breach the duty by self-dealing or by abdicating process, but the mere fact that a financing is highly dilutive and keeps management employed does not, by itself, establish a violation. Courts examine the facts, the process, and the available alternatives, not the emotional label, death knell. Thanks for calling me emotional. That was my label. I said, I appreciate that, but if the CEO signs a deal which is clearly going to wipe out shareholders, is she doing that to save the idea of the company or to look out for shareholders? It's not a very good question. In most cases, where a deal is clearly going to wipe out existing shareholders, the CEO is primarily acting to preserve the enterprise and her own position within it, not to maximize value for those shareholders. The formal legal story is that she is looking out for shareholders, by keeping the company alive. So they retain some hope, some option value. If the alternative is near-term insolvency or liquidation, in which common equity recovers nothing, a highly dilutive financing can be presented as the least bad residual claim. I don't know how anybody can make that argument with a straight face. Boards and their lawyers document that rationale. Boards and their lawyers document that rationale carefully so the business judgment rule protects their butts. The economic and incentive reality is usually different. The CEO's personal upside, salary benefits, continued control, potential equity resets or new grants in a restructured company, avoidance of career and reputational hit of a bankruptcy, is tied to the continuation of the firm under current or similar management. Existing common shareholders' economic interest is often already close to zero. A deal that transfers essentially all future upside to new capital providers while leaving a token float does not restore meaningful value to them. It simply delays the recognition that equity has been extinguished. When the terms are extreme enough that wipeout is predictable, the floating conversion prices that ratchet aggressively, massive warrant coverage, make whole features, and so on, the chance for shareholders is frequently illusory. The real beneficiaries are the new financiers and the management team that stays employed. Courts rarely second guess the substance of these deals. If the board went through a facially adequate process, independent advisors, some market check, minutes that recite the no better alternative conclusion. That process protection is why attorneys emphasize survival language. It does not mean the decision was actually oriented toward maximizing residual value for the pre-deal equity holders. Suddenly, I'm depressed. Looking out for shareholders would require a genuine effort to maximize the value of shareholders' residual claims, whether through a less dilutive structure, an asset sale, a strategic transaction, or an orderly wind down that returns whatever can be returned. Saving the idea of the company and management's role in it prioritizes continuation even when that continuation systematically transfers the remaining value away from existing shareholders. When a CEO signs a deal that is obviously going to zero out the current equity, she is almost always operating in the second category, using the first as the legal and rhetorical cover. The duty is formally to the shareholders. The incentives and the typical outcome point elsewhere. So she saves the idea of a company. Why hasn't them been fixed? I gave some ideas. It hasn't been fixed because the problems are real, but the simple fixes are politically hard, legally constrained, and often create worse side effects than the disease. Hard to imagine. One, diffuse harm, concentrated benefits. Retail holders of microcaps are scattered, poorly organized, and individually small. The firms that profit from the current structure, electronic market makers, certain structured finance providers, lawyers who document the deals, and listing advisory ecosystems, are concentrated, well lawyered, and active in Washington and at the exchanges. Large passive assets under management institutions, such as the giant index and mutual fund complexes, mostly ignore true microcaps. They are not the primary architects or defenders of toxic financing or HFT and penny stock status quo. Specialty short funds and opportunistic capital providers do benefit, but the bigger structural winners are the intermediaries who extract fees and spreads from thin, volatile names. Regulatory priority and capacity. The SEC and Congress focus resources where the dollars and political heat are the largest. Large cap market structure, private funds, crypto, climate disclosure, etc. Microcap and OTC issues generate continuous retail complaints, but relatively little systemic risk or campaign contributions. Enforcement exists, trading suspension, fraud cases, Rule 15c2, 11 tightening, but it is selected and after the fact. Continuous real-time policing of every low-price name is expensive and legally fraught. 3, unintended consequences of blunt bans. Ban HVT under 5. I can see one problem with it, but electronic market makers supply most of the continuous quotes that exist. Remove them and many names revert to true trade by appointment, wider spreads, less ability for retail to exit at all. Liquidity does not magically reappear from human specialists. That's a very good point. Those disappeared for economic reasons. That's a good point. I think shorter trading hours might answer it. If it walks like usury, ban it. High risk capital demands high expected returns. Banning floating converts ATMs with aggressive terms or pipes simply cuts off the only capital many of these companies can obtain. And remember that. Sometimes it's all the capital they can get. The result is faster insolvency, doesn't break my heart, not healthier balance sheets. Courts and regulators are reluctant to second guess arm's length pricing of risk. Jail CEOs for a second toxic deal. That was one of my ideas. Criminalizing bad business judgment. Oh, God. As opposed to fraud, self-dealing, or clear disclosure violations. Collides with due process and the business judgment rule. It would chill any financing for distressed firms and push more activity offshore or into even less transparent private structures. Okay, I can see that that might be wrong. Force name level disclosure of every institution. Some improvement is possible and already occurs in many filings, but counterparties to pipe and convertible deals often legitimately demand confidentiality. Overly aggressive naming rules can simply dry up the capital. Well, why is this capital such a good thing? I don't get it. I guess you shouldn't have any rules against pimps and heroin because it would dry up availability of pimps and heroin. Ban or gut Reg Show for junior markets. Reg Show already restricts naked shorting and requires locates and closeouts. Baloney. Weakening settlement discipline increases fails and counterparty risk. The real complaint is usually about legal shorting into weak fundamentals plus dilution, not wholesale naked shorting that regulators have ignored. Oh, come on. They just can't face what's going on. Legal and constitutional limits, contracts, free speech, research, press releases, and the right to list trade securities are protected. Regulators can raise listing standards. NASDAQ has been doing exactly that. Demand better exposure and prosecute fraud. They cannot easily outlaw, quote, stupid but disclosed dilution or force patient capital to appear where the risk-adjusted return does not justify it. So we have to adapt to these things that we're learning. We have to adapt. Many of these companies are the problem. Yeah, that's probably true. I'd say 80%, a large fraction of the names that repeatedly do death knell financings have weak or non-existent businesses, serial dilution already baked in, and no realistic path to cash flow break even. Market structure amplifies the pain, but it does not create the underlying zero value stories. Policymakers are wary of designing rules that prop up firms that should exit. That makes a lot of sense to me. But it doesn't make sense that this toxic financing should be allowed. Are the big concentrated players behind this? Mostly no. The giant asset managers have little economic interest in microcap OTC ecosystem. Their mandates, liquidity needs, and fiduciary constraints keep them out. The actors with skin in the game are smaller, more specialized electronic liquidity providers, certain hedge funds, and family offices that underwrite structured deals. The promoters and lawyers who live off the deal flow, and the exchanges that still collect listing fees until standards force the listing. Revolving door incentives and industry lobbying exist, but they are not a grand conspiracy by BlackRock at all to keep microcaps in hell. The more accurate picture is neglect plus path dependence plus the political difficulty of writing rules that help legitimate small companies without also shielding the serial diluters and manipulators. Real progress has been incremental and unsatisfying. Higher NASDAQ listing and continued listing thresholds, Rule 15C2-11 reforms that pushed thousands of opaque OTC names into the expert market, which is totally uninvestable, more trading suspensions and occasional enforcement, differentiated market structure for small stocks, wider ticks, auction mechanisms, stronger affirmative market maker obligations, has been discussed for years and repeatedly stalled on complexity and opposition from firms that prefer the current electronic model. None of that matches with the simplicity of ban HFT under $5 and jail the CEOs. Those were my solutions, which is why those proposals stay outside the Overton window of actual rulemaking. Okay. I'll see if you have any comments. I think there are no comments. So I think I'm going to cut it there because it's after 9. I had 2 more sections. Remember, what I tried to do here is ask the same question to the 4 major AI providers. And I know there's another one, I just couldn't remember it. And so I haven't gotten to Claude. We started with ChatGPT, which confused me because I don't usually use him. And then we went to the good girl Gemini, and then we just did Grok. I redid Gemini. Remember, what you heard on Gemini was as if I was a new user. They had no access to anything I'd ever put in there. So that was interesting. And we'll come to Claude, the pain in the butt Frenchman, but he tends to be fair at the end of the day. So with that, I'm going to sign off. There's a lot of baseball trade deadline to follow. Looks like there is maybe some agreement in the Middle East, but I tell you what, I wouldn't trust those guys. They're probably just stalling for a September, October invasion. But I pray for peace, and I'll join in if peace is there. And I'll try to come on maybe more than once tomorrow, because I got to finish that task and then get on with other things. But it's just too late. I'm stumbling over my words, and it's just too late to keep going. So I really appreciate everybody tuning in. I wish each of you peace. And I think we're learning enough that we can actually invest in these markets with some semblance of expectation for return. Now, if you want to day trade, if you want to be hot money, and you want to listen to hot tips, I'm not a day trader, but if you trust who you're hearing something from, or if you get on these calls and you've learned to understand how certain people, for lack of a better word, promote, the idea might be get in early, let them do the pumping for the next weeks and months or whatever, and then get out, but get out early, get out 2, 3, 4, 5x, maybe 10, I don't know, but don't get greedy going for 3,000 or something. And don't worry if you got out too soon. At least in that case, you booked a profit and you got some money to go do it again. Or alternatively, just take your original money out, or maybe your original money out plus 50%, and keep the rest on the way up. But that's not what I'm trying to do here. I'm trying, and you were trying, we are building a sort of a ragtag specialist, small for now, micro cap fund, which can grow. But we're learning and we're teaching ourselves and we're doing due diligence. We're valuing a company first and then coming up with a number. And then we look at the share price. And then we look at the dynamics. And there's more to it than that. But we are behaving as a sophisticated institutional investor. And I guess I'll end on the fact that we have 23,724,613 shares of Railtown. And I appreciate each of you. And I look forward to speaking with you again. With that, I'm going to say over and out.